A very warm welcome to Ramsden, First Secretary, Second Secretary, nominated representatives from G-20 nations, the Director General, RIS, nominated representatives and dignitaries of Ministry of External Affairs, Ministry of Finance, Ministry of Commerce and Industry. Our keynote speaker, Dr. Nina Fenton, Delegate EU, and Dr. Professor D. Ram, Director, Institute of Development and Research in Data Technology. Participants and nominated faculty and student members of the institutions, nominated representatives and participants from various corporates, and the entire community at IIMC. I am pleased to host the G20 Summit on International Financial Stability and Creating a More Sustainable and Inclusive World through Financial Technology, and the G20 University Credit Program in collaboration with RIS, that is Research and Information System for Developing Countries, Ministry of External Affairs, Government of India. As we all know that India in current global stage is undergoing a significant transformation, not only in terms of technology and economy, but also its impact on people. We are at the doors of opportunity creation, thereby transforming the lives of people in millions. And the acceleration is technology has impacted financial inclusion, thereby creating more sustainable future for economy of nations. Fintechs have a huge potency for global world as it scope to pursue strong cross-border coordination and sharing of information is embedded. However, to ensure that national economies need to modernize and open up financial infrastructures to enable competition and contestability. Questions such as monitoring and reassessing regulatory parameters which blurs the boundaries of the financial sector, review regulatory, supervisory, and oversight frameworks to ensure that they remain fit for the purpose and enable the authorities to foster a safe, efficient, and inclusive financial system. Moreover, one needs to inquire into beneficial innovation while managing risk. However, the investigating and deliberating into the scheme of issues, one should not ignore the issues of people mindset within nations as it has the potential of an extrapolated impact on adoption of fintechs. One should not ignore that creating innovative technology, one needs to be vigilant about people readiness to adoption and its trickle down impact. The national culture indices, which are reflective of social norms and shared frame of reference, needs to be taken in discussions and forums like this while deliberating financial technologies. Moreover, one needs to be further thoughtful of economic and non-economic issues to work upon greater success stories of financial technology installations for national economy, thereby creating international financial stability and more sustainable and inclusive world for financial technology, theme of the current event. Thank you. May I now request our VC, Dr. Satendra Bhatia, our two keynote speakers, Professor D. Ram, Dr. Nina Fenton, Director General of RIS, and our Registrar, IISc, Mr. P.K. Gupta, to please come up on the stage and inaugurate the event formally. The first keynote, we will start with the first keynote address. May I please call on stage Dr. Vishwajit Now, the session chair, and Dr. Neema Fenton, keynote speaker. Dr. Vishwajit Now is a professor of economics at IIT New Delhi and has more than 2 decades of experience in teaching, research, and consultancy in India and abroad in the area of international trade, finance, and development economics. He has served in the United Nations at Bangkok as visiting research fellow and Institute of Developing Economy. Currently, he is advisor to Global Value Chain at Partnet and e-learning board for trade and development promoted by UN. Dr. Neema Fenton. Dr. Fenton holds a doctorate in economics from University of Boston. She has worked in 3 of the world's largest international financial institutions, covering countries in Africa, Asia, and Latin America. She has extensive experience in strategy and economic analysis with focus on emerging markets and developing economies. She joined the European Investment Bank in 2016 and appointed head of legal representation for South Asia in March 22. She represents the Bank of India, Bangladesh, Bhutan, Nepal, Sri Lanka, and Maldives. May I request Dr. Nasir.
Yeah, thank you, Gina. So it's a great day, and it's really a pleasure that we are able to organize this very important event in IIT's calendar. As you know, that the G20 presidency is basically the platform to discuss a lot of issues around development as well as modernization of the society. It's a collaborative platform, informal leaders, academics, business, everyone is basically discussing. So at IIT, we have decided to discuss about fintech related issues and its development dimension. We are really thankful to you for accepting our invitations, and we are eagerly looking forward to hearing from you, Dr. Fenton. As you know, that globalization has really accentuated the financial transaction, which is at the heart of the development process. It has made the process complex or simpler in whichever way you would like to see it. The massive development in IT technology, cross-border transaction of goods, e-commerce, and many other things actually creating kind of a drive for moving the fintech in a new direction. Whenever we look at this aspect, that we see the 3 major issues which play a very important role in fintech and development. One is accessibility, second one is affordability, and third one is basically whether this is universal. Dr. Fenton, you have a huge experience in different capacities in different parts of the world, and you have seen that the world is moving, especially the developing countries. However, still some challenges are there, and fintech has been identified one of the major drivers in SD. I think as many as 8 goals of SDGs have been identified connected fintech. So from the G20 perspective, from India's perspective, or from the EU's perspective, how you are going to visualize the world in next 20 years, and what is your experience, and what are the journeys of various developing countries for each activity? So over to you, Dr. Fenton. We'll have a 15-minute speech and maybe 5 minutes of this.
Okay.
Thank you.
I have a presentation. Okay.
And this is not a topic actually investment bank you working on opportunities. So initially, I was a little surprised to receive this invitation, but I was also very pleased because it's actually something that in my previous incarnation, in my previous job at the European Investment Bank, I worked on a lot with a focus on Africa, and particularly when I was in the economics department researching. Because in Africa, EIB has a strong focus on the financial sector. And we really look at some of these challenges around access to finance, both for individuals, financial inclusion, and for SMEs, which are the companies that are really driving the economy in Africa as also here in India. And I think, we will all agree that there is a very big potential for fintech and more broadly digital financial services to really kick off the transformation of the economies and for those aspects. So I'm certainly interested to hear today from the amazing speakers and panelists. And also from the students. But I wanted to just kick off the discussion with a few of the findings from the research in the African context, and perhaps to end with some ideas, some examples of what EIB has been doing to support that transformation to accompany it, and maybe to ask the question of whether there is more that we can be doing here in South Asia and in India. So I'm going to start by giving a brief overview of the recent expansion of digital financial services in Africa. And that this is based on work done by my team in the economics department, drawing on data, secondary data collected by Helena Research among others, but also a survey that we do annually of banks across the continent, filled in by CEOs and CFOs of the major African banks. The first point I wanted to make is that today I want to talk not just about fintech, but about digital financial services. Because fintech is one kind of aspect. So when I talk about fintech, I talk about companies that are not licensed as banks necessarily, but are using digital financial services, to fill gaps in the market. But there are other entities that are providing digital financial services. So the fintechs really kicked off this transformation, particularly in Africa. We talk particularly about M-Pesa. I'm sure many of you know. M-Pesa started off in Kenya and in Tanzania as a pure fintech, but working together with mobile network operators, so with Safaricom and Vodafone. They were not regulated initially as a financial services provider, so they were playing in kind of a new space, unregulated, bringing services to people who largely were unserved or underserved. And the way they were doing that was firstly making use of these networks from the mobile network operators. So of course, here in India also mobile networks have a very, very wide range, so they have a lot of customers already. But also, because of the simplicity of the services that they were offering, and the kind of low cost of reaching out using these mobile networks and digital modalities, they were able to acquire customers very, very quickly. So they were able to rapidly reach a lot of customers who were very, very much underserved, and providing these new services, mainly for payments and remittances, that previously had only been provided by kind of informal services that were often very unreliable and also very, very expensive. But that was really just the start of the story, because more recently, we've also seen a number of other players coming in. So the mobile network operators, really got in on the game and were seeking out more and more these kind of partnerships for starting up their own services. We also see traditional banks starting to either partner with some of these firms or to do this in-house to offer their own services. And we see also fully digital banks bringing up. So some of this is traditional banks starting up their own branches, or subsidiaries, but some completely new banks in the African sector. And some of these have had to secure a banking license to deploy and expand their portfolio of digital financial services. And this is something that is allowing kind of a diversification of these services. So to look at the growth of digital financial services in Africa, what we see on the right-hand side is the mobile money transactions, because that's, in Africa at least, where it really, really started, where it took off. And you can see a rapid, we've got that from 2015, I think, and you can really see the rapid takeoff first in East Africa, which is the yellow bar, but then also spreading a lot to West Africa and even to Central Africa. And this was really a revolution for Africa, because I think at the beginning of this, something like only sort of maybe 20-30% of people in the continent overall in sub-Saharan Africa. And by 2021, which is the time of the most recent global index survey, 55% of the population have, which is really a massive transformation. And the global index survey is very, very clear. It's driven predominantly by mobile money and digital money. So this is huge, huge change. And worldwide, we also see it. It's not a start for Africa. Worldwide, I think we've seen an increase from around 55% in 2011, had access to finance, and 76% by 2021. And a lot of that has really been driven by the mobile money, by fintech, because it's reaching out to people who previously underserved groups. And we see that, this has been backed by substantial investment, largely at the start and still today by venture capital. So money has been flowing in and people have been willing to take the risk. Some people have won, some people have lost, right? Not all of these fintech companies that have stayed in the market, but the value of these transactions has risen steadily. We saw actually when the last time I worked on this survey was around the time of COVID, and we saw that there was a rapid increase in the investment by the venture capital during COVID, because COVID really made people wake up and see, oh crikey, there's something going on here. People can no longer access their bank accounts physically. This is where we need to be putting our money. But it slowed down afterwards, and we were a little concerned about that. That the money was really going to stop flowing because financial markets were tightening, risk aversion was going up. But actually, on the right-hand side with the red graph, you see that it continues to rise. So I think the support is still there. People have seen that it is quite a resilient industry. And on the left-hand side with these two pie charts, you can see that the expansion of digital financial services actually continues post-COVID. So this is between 2020 and 2022. Telema Research, which did the survey work for us, has seen an expansion of the number of kind of digital financial firms from 450 to 1,000 firms. And we're also seeing a diversification of the services. So as I mentioned, this started up very much in the kind of remittances and payment space. But actually, that's only part of the needs for people in Africa. So, it's very encouraging actually to see a slight increase in the percentage of the firms that are offering also lending, for example, because this was something, people could remit or transfer these small amounts of money, but now they're also able to, use that as an entry into the financial sector, because they're really able to start investing, be it in small enterprises or in education for children in production. As I mentioned, we also surveyed banks across the African continent. We managed to get replies from 70 banks, some of them are clients and others not. And we really see that, we've been doing this for a few years, that the fintechs have really kicked off this transformation by pushing the traditional banks to be offering also these digital services. And there are two reasons for that. So one is, that their existing clients are already demanding it. But the other is that I think this kind of expansion of fintech has made the traditional banks realize that the unbanked actually are a market, right? And that almost all of them transfers, payment receipts for companies, but they're also starting to offer even applications for loans, extending restructuring loans available fully digital. And so these are new services that previously, were very time consuming and rather non-transparent in many cases are now available in digital. And they're starting to cater to quite diverse customer groups. So the retail sector, individual banking is still the most common use of digital channels, but they're also offering it to corporates and these small medium. Of course, there are still constraints, and here this talks very much about the banks because those are the ones that we say. But I thought it was instructive to show this in the perspective of some of the risks going forward, also for fintech. for digital financial services. The most important ones that come out here really are KYC, which is know your customer requirements, and cybersecurity technology. And this really kind of also links with what the banks will tell us, right? So when I've been meeting with banks in Africa, these are the things that they were concerned about with rolling out the digital financial services. So know your customer. This is a real concern because, you know, when you're giving out products, financial products online, you need to know who it is that you're lending to. Otherwise, it can't work, and you can have problems coming up with money laundering, you can have problems coming up, and then you get in trouble with the. And then, of course, cybersecurity challenges. You know, this is the one thing that I think really keeps banks these days, including mine, right, awake at night, is the chance of these kind of attacks. And that's something that we see in Africa also very much of a concern. So those who just recently found the OECD findings, I wanted to think a little bit. I remember when we got this concept, there were kind of three factors that were underlined. So inclusion, stability, and sustainability, I think, were the kind of the blur. And I want to give a little summary of the based on what we've been doing. So I think I would say it's clear that there's a huge potential to do the underserved and the unserved. And we've seen that in Africa, right? This is really a stunning achievement, the rollout of digital, and it's really transformed lives and lives of people. But of course, in Africa, we still stand only at 55%, I think, with accessible banks. So there's obviously still a long way to go, and the potential for inclusion is very contingent. So the potential is high if all can access. So if they have a mobile phone and if they have access to the mobile phone network, right? And if the network is stable enough, you also need 4G, 5G to access more sophisticated services. But also there are risks there. And I think I'm sure this will be talked about a lot more today. And those risks are kind of customer protection risks for those who have had limited exposure to the financial sector, may have limited financial literacy, they haven't had that much experience of, you know, dealing with money over the phone. That in some cases, you know, people not quite realizing that this is real, right? And in some cases in Africa, the social security network has kind of switched to digital, right? So this is really the second factor is also community. And we a little bit giving this kind of literature survey for us, you know, what are the big risks of doing figures coming up in why everyone going to run the fintech or the online with traditional banks, financial sector. Yeah, we don't see that, right? And I think at the moment that's because fintechs were really jumping into a gap. You know, they're serving people who weren't served before. So I would say the kind of practice of the traditional banks is still quite strong, right? You know, the middle classes, the upper classes are still banking with them. They have their deposits. From that side, we see things are still secure. But I think regulators very much do need to keep up. Things are moving very fast. Bitcoin coming in, a lot of new products and new tools that they need to understand how to regulate. And also, of course, they need to keep their eye on these factors that I just talked about. So cyber security and know your clients. So that's another where they need to be on. And then finally, sustainability was talked about in the kind of concept of the end. And then something that I haven't thought about it. We did quite a lot of work on financial sector in Africa, investment in environmental sustainability and climate, but I haven't really thought about the implications of digital. And I guess, the sort of direct environmental implications can be ambiguous. But, more use of digital is something traffic management. But, I don't know if anyone else takes the environmental implications of the increased use of for example, and when we talk about the blockchain, what are the implications? But I think there's a more fundamental impact of the data, which is bringing people in forward. So, certainly people who didn't have a bank account almost certainly were not paying taxes, they were not formally registered. It was very hard to count them and include them in many ways. And I think with digital financial services starting to bring them in, there is a potential there to really start mobilizing them as a tool for economic development. And I would say in Africa, certainly low tax mobilization is one of the key economic constraints, and that's holding back investments actually in environmental sustainability, in climate for those countries. So I think there is a potential here. I'm not sure it's been yet fully capitalized. So to finish, I wanted to give a couple of words about the European Union and the EIB, which is defined as the European. So digital connectivity is actually an EU priority under what's called the Global Gateway Initiative. So this is a recent initiative coming out from the EU, and it's their offer to countries outside of the EU borders to help work together to partner to increase connectivity. And I think this is coming out of the experience during the COVID crisis, when we realized we're strong together, right? So and connectivity really matters. So digital connectivity was particularly important, I think, during COVID, and also for financial inclusion. So I think this is something that the EU is pushing us to invest more and more in, and it's an area where EIB actually in Africa particularly has been investing. I guess there are 4 areas where we've been particularly active. So firstly, on the infrastructure side, I think we are best known as an infrastructure bank because our lending is long-term, so it suits itself very much to the kind of hard infrastructure investments that you would take capital. We've made quite a lot of investment in the infrastructure for digital, so satellites, towers, undersea cables, which handle, I think, 90% of data traffic that we use. But also in software. So in Nigeria, we supported an investment across the country in digital ID, which is something that's going to be really catalytic in terms of enabling some of this KYC to be done for digital products. We've also invested quite a lot directly and indirectly in financial institutions and fintechs, both traditional banks, and some of those we have been able to help them with some of the CapEx needed to kind of move more into the digital side. But also we supported the newer institutions. So some of the fintechs in Africa we supported directly, and others were supported via VC and impact investment. And it's quite. I worked in some of those deals kind of in a support role, and it's really nice to see the number of people that they're managing to reach and the impact that they have. We're also very aware of the need to support on the knowledge agenda. So we have actually a banking academy in Africa, and I think we have a 1 or 2 week course every year, and always one of the components that's most popular and best received by the banks is the kind of the sessions on cyber security and sessions on digital financial services. So I think this has been a great forum for them to come together and share knowledge amongst themselves, and also with the participants from Europe, the trainers, and really make sure that what they're doing is safe to us. And then finally, of course, the space of the regulator. So we have a partnership with the IMF, under which we're supporting technical regulators in Africa, and our support focus is very much on the financial sector, including kind of upskilling and updating regulations to deal with the new digitalization and the challenges they have to face. So I'll stop there, but I think I would be very much interested to hear from the rest of the panel and the other speakers today about how this applies here in India and in South Asia. And also, whether there are opportunities for the EU and India or other South Asian countries to partner, because now in my new hat that I'm working on, looking for opportunities to invest together and to advance financial inclusion, both in India potentially, but also abroad. And I think this is something I know the Ministry of External Affairs is very keen to bring some of the learning in India from some of your very unique solutions to third parties. So I would be very interested to hear your thoughts. So thank you very much.
Thank you very much. And first of all, being on time, that's the most important thing. Right. So you have rightly brought up the most important issue, is inclusion. Now, inclusion is a big word actually, because it basically focuses on unbanked people, how we are actually bringing them in the system. And then you opened up a plethora of issues, including fiscal, including infrastructure issues, payment challenges, and kind of actually which are going to be the main problematic, or maybe the future dimension of research as well as technical program. One is about the technical system, because there are large payments going on, and during the COVID time, actually the payment number of payments have increased significantly. And the second one is about the security, cybersecurity, the most important issue, because now there are a lot of cross-border trading because of the e-commerce and trading system. And lastly, about the risk management between the customer as well as with the service provider. Mentioned about experience in KYC related issues, as well as when the new products are coming up, how actually they are going to be regulated. What we see all the time, that technology is always one step ahead of regulation. When regulation is trying to catch the technology, then technology is moving one step. So regulation is always following, and there is always a gap. And this is going to continue for quite some time unless there is some kind of a global side of maturity. Thank you for your time. Now I think we can take up 2-3 questions from our students. Anybody from any questions from anyone? The back, just raise your hand. Still, it's early morning. Yeah, there is someone. Yeah. Can you leave the mic there? Just you will raise your hand out there. I saw someone. Okay. Yeah, Priya will have. Yes. Yeah.
So, let me comment on with everything moving so fast, and there is a whole old legacy system, and there is so much fragmentation at everything in technology as well as policy, and then also different countries are only at different stage and developing. How do you address this problem, or how do you bring around and about integration to the tech? Any given point in time, you have the kind of stability, sustainability, and integration.
Recording.
Thank you.
Digitally challenged.
No, I mean, this is a very good question, and I can only speak from what I know and what I've seen in Africa, and I'm not a regulator. I think this has to be very case by case. So I think an assessment of the risks, right? And the regulator, I think, although things are moving very fast, we saw with the expansion when it's new services being offered, right? I think there to think what is the key risk here. It's not going to destabilize necessarily the existing system, but you need to make sure that the customers, the people who are taking up these services, are being protected, right? That we are not having unscrupulous players coming into the market. When it's something that's very new and very badly understood, I think I would be a big fan of this kind of sandbox approach, right? So kind of figuring out how you can, try something out, how you can insulate other parts of the system from it, and then allow a scale up once it's well understood, once the implications are much clearer, to give the regulator really, like you say, time to catch up, right? And I think that's something that has been tried quite successfully in several contexts.
Any other question? Okay.
May I now request Professor Vidya Kanti to please come up on stage and felicitate the new president. Thank you for the now, so we can remember the discussion. We now start with our first panel discussion on innovation initiatives, the road ahead for transformation. Please may I call upon stage our session chair, Mr. Sachin Chaturvedi. Mr. Sachin Chaturvedi is currently Director General of RIS for RIS think tank. He works on issues related to development economics involving development finance, SDGs, and sound cooperation, apart from trade, investment, and innovation linkages, with special focus on WTO. He has served as resident professor at GNU and has been closely associated with UN Food and Agriculture Organization, World Bank, UNSCAP, UNESCO, OECD, and many other agencies. Thank you, Dr. Chaturvedi. We are now also called upon the stage our panelists for the current session. Professor P.K. Das. Professor P.K. Das has earned a PhD in non-linear statistical models from Indian Agricultural Statistics Research Institute. He has also served in Indian Council for Agricultural Research and was head of research division as senior scientist. His expertise lies in the issues of ML and big data. I also call upon Mr. Alok Singh. Mr. Alok is a senior executive entrepreneur with 2 decades of experience across banking, financial services, and retail e-commerce. He has recently co-founded Risk, a payments fintech venture with a vision to redefine cross-border trade flows for traditional exporters, importers, and digital business. In his earlier role as country head digital fintech partnerships at HSBC India, he led its strategic pivot into mobile-centric and digital banking and network digitization. He is an alum of IIFT and Indian Military Academy. We are called on stage Mr. Amit Tyagi. Mr. Amit is an experienced leader in fintech space with over a decade of experience in financial services space in India. He has rich experience across payments, lending, and driving digital transformation. He is part of the founding team of Airtel Payments Bank, where he worked on product catering to Irish customers to meet their unique financial needs. He is currently the CEO of PayWorld, a Bharat-focused fintech firm. Mr. Dhruv Bajaj. Mr. Dhruv Bajaj is co-founder and CEO of Tappets, a groundbreaking fintech which provides credit lines to deep data MSME suppliers through blockchain technology. Dhruv has also worked as director at FinCash and leading B2B payments on fintech. Its battery upstart Dhruv has worked in leading banks like HDFC, Bank of Maharashtra, ICICI, in leadership roles. May we formally start with the panel discussion.
Thank you. Thanks a lot. Good morning to everyone. Thanks, Dr. Sudhir, for this excellent opportunity to connect with everyone. And I must congratulate Indian Institute of Foreign Trade, IIFT, and Professor Bhatia for this excellent partnership that RIS and IIFT have today. University Connect is a major program that Prime Minister of India initiated so as to brief each university about what G20 presidency is all about. RIS has been given this responsibility. We are supposed to reach out to 75 universities, and we are likely to end up with 100.
The private universities which were not on the official list earlier, have also started taking it up, and they all are getting into sectoral specializations that are of interest to them, like ISB and others have chosen their own themes. There are several management schools that have picked up all different nuances of India's G20 presidency. So there are several different occasions, and as we are speaking, my colleagues have already finished 52, and again today 53rd lecture is being organized. I think this is excellent. I'm so happy that IFT has chosen the very interesting topic of fintech, and within fintech, something that I'm very closely associated with the idea of inclusion. Since I'm on the board of the Reserve Bank of India, at RBI, we are very keenly concerned in terms of how the governance part of fintech comes in. I'm also chairing the Information Technology Committee of the Reserve Bank of India. And I'm extremely glad that Professor Jankiram is here. Under his leadership at IDRBT, we are trying to see how banking technology can really help in terms of reaching out to places in India where internet connectivity, electricity supply, consistent electricity supply is not there. And hats off to Professor Jankiram for getting us into a new model and new instruments that are going to deliver this mega policy objective of our government. I think it is also pertinent on our part to think in terms of what we heard just now from the European Investment Bank, Dr. Tina, this excellent address in the morning, to focus on what European strategy is. And as most of you would know, and my student colleagues would work it out, there are three spectrums, three baskets, which have captured the whole governance of the fintech. There is an extreme US position, there is extreme Chinese position, somewhere EU's governance part is another, the third part. India has tried to create something which I would say is the third way. And that third way is in terms of providing public sector infrastructure, the global public goods, as we are talking about in the realm of information technology, facilitating the growth of that and bringing everyone on board. The regulators, the promoters have the mandate in terms of how do we expand the footprint of fintech. This includes not only the large banks, but also the small finance banks, the NBFC, and many other actors who are on board. There are several challenges, several issues which are of importance. The governor of the Reserve Bank, in one of his addresses, captured the idea of how India's fintech is actually divided into four categories, and he very rightly captured the fact that we have the large banks, as I said, so quite a few of them are very active, while some of you might be availing the facilities and the services that they are providing. Then are the mid-sized and the small finance banks, which are also delivering the dimension. The third tier, where we are seeing the multiple areas becoming part of this whole information technology revolution, are the RRBs, the regional rural development banks, and the cooperative. They are delivering. The fourth and the very important pillar is the fintech and the digital players, and some of them are here in this panel. So this is something which is extremely important. The idea here is how do we reduce the credit risk which is coming up, the financial products and the competitive prices that are there. and the financial inclusion related are broad dimensions. These are the three broad sort of policy focus that we have before us. The challenge here is in terms of governance of it, and in the G20 presidency, India is trying to focus on a couple of dimensions which are important both in terms of identifying our own sort of priorities in the management of the finance track. So all of you must be aware that there are these two tracks within G20. One is the Sherpa track, where we are discussing all the development issues. And then the second is the finance track, where some of these issues are being discussed. The idea is to bring in financial stability and financial integrity related concerns that we have. We are also trying to see how cross-sectoral and macro financial implications of that are dealt with. Some issues that are coming up and where our direct contestation with the US in the G20 group is coming up is in terms of how to finance the global public goods. In the US, it is largely done by the private sector. And as some of you might have seen, the international commentaries that are there, if we call them international at all, they are more US-led commentaries. So there, the concern is what's space for private sector. And this is where the issue before the Reserve Bank and also before the government of India is that we are not allowing the rates of operations or the I won't call it rent seeking, but certainly some commentators have described that as rent seeking to go up. The issue here is if we allow services charges to go up, and we don't call that as rent seeking, and I personally don't agree with that. So if we allow services to go up, the cost of operation goes further up for several common people, and financial exclusion, the danger of that comes up. The lower side of that, the downside of that, is in terms of not having enough bandwidth to introduce new services, to have cost of R&D covered, and that in a way creates a major challenge for the operators. And that's where operators want some bandwidth to come up to have the leeway that is needed to deliver the services that they require. And this is something which I think is important for us to see in terms of the cost cutting and also in terms of providing. There was a feature in Financial Times day before yesterday, and they covered the idea of in a way, and if you see this week's Economist, a similar commentary has appeared in Economist also, where they have said the amount of sort of capture that UPI has. And just today's newspapers have quoted McKinsey's latest report in terms of UPI having almost 90% of the total operations. And at this point, we are 250 million, but the idea is that we will cross the 1 billion by 2026. And we would be capturing a huge landscape. So this is something where dimensions are important for us. The idea of data analytics, network externalities, and intermoving activities, the DNA as they are called, they are important for us, and that's where the ability of the service providers come in to give us low-cost services. And this is something where innovation has to happen. And if innovation has to happen, what kind of challenges we have? And this is something which both the G20 presidency of India, the Big Tech, the FinTech, they are grappling with the question. But at the same time, Government of India's strategy of consistently supporting creation of public infrastructure, the global public goods as they are called, to be promoted and the services to be delivered. Fortunately, with the policy intervention, support ecosystem, India's key actors are here. They have been playing an important role in terms of how we go forward. As I said, in the next session, we would have somebody who is hands-on and is developing the technological resources that are important for us to work out. We are also trying to see a couple of points, and before I just close my own observation, I just want to say that sometimes we think Africa requires a lot of support, but we also forget that it was back in 2007 when Kenya took the lead. The M-Pesa that was introduced in 2007. Actually, China introduced Alipay and WeChat Pay and Pay only in 2011, and Brazil's PIC has come up only in 2017. India's UPI, as you know, is only a decade old. So Africa really led us in terms of how the sophistication has to come in and what kind of service delivery mechanism they can have. Reserve Bank has tried to deepen partnership. Our recent agreement with Singapore has given the bandwidth that is required. With Bahrain, it has come in. The fintech load would further multiply once the digital currency, the CBDC, takes off. It is already on ground. The pilot has already been completed, and we are now going to sign with 9 countries agreements, and with 38 countries, our first line of expression of interest have already come in. So this is something that is going to take it forward. Our estimations and the recent banking and finance report of Reserve Bank shows almost $1 trillion digital transactions. 1/3 of our GDP is something that we have ended up this year with. We are also seeing from 2011 to 2021 almost 25 points fall in the cash transactions, and this shows how at some pace India's growth, both with rise of IT, with rise of infrastructure, with reduction in the cost of delivery, they are going to go forward. G-20 presidency that way brings up some of these issues, and they are important for financial inclusion. The contestation, as initiated in Indonesia, continues. The Indonesian presidency had placed a couple of proposals. CBDC was one of them. Since US and EU both have not made up their mind in terms of how they are going to go forward, the issues have not been concluded so far. The BIS paper of December 21 is important. Those of our young colleagues who have interest in this topic should read the Bank for International Settlement BIS discussion paper, which was published in December 2022, is worth reading. It tells us how China and with China, Thailand have introduced a new network for introduction of digital currency. India's own initiative is going forward. Argentina, Brazil, they have come forward. Russia has already joined the new network for digital transfers. With suspension of MasterCard and Visa card, digital and digitalization is not confined to few quarters. Our own alternatives to SWIFT, they are also going to give fillip to the larger banking transactions that we are expecting across the borders. So fintech is in a very interesting times, both in terms of bringing in financial inclusion, bringing in new private actors from the country and from all the emerging markets, and also in terms of its governance. And friends, this session focuses on innovation, how that innovation being ensured, and governance is ensured, inclusion of or the objective of public policy that we have before us is ensured. So I think this sets the sort of broad context that I have in mind for the session, and the panel, as all of you know, captures the details that are there at the operational end. So maybe I think we can start with the panel 7 to 8 minutes, and then we can have rounds of questions, because I'm sure this is something which is extremely interesting for all, and there would be a lot of questions, I'm sure. I have tried to stimulate and provoke everyone, so I hope I have succeeded. Let me start with Professor D.K. Das. And Professor Das, as we talk of innovation and fintech, what challenges you see for Indian operators, and how do you see we can bring in the technological bandwidth and minimize the cost of transactions, but at the same time also enhance the margin of profit for the company?
Thank you, Professor Chaturvedi. Good morning to everyone, and I thank our Honorable Vice Chancellor, Professor Bhatia, and two conveners, Professor Vishwajit Nag and Professor Tubina Mukherjee, for allowing to participate in this discussion. Before I answer your question, let me share with you the recent research by IIFG, which is likely to help fintech industry in general, but maybe overall the finance industry. Recently, we have developed a reputation system for e-commerce sellers who are going to take loan from fintech lenders. Now, when we talk about loan or finance in general, we know that two important issues are trust and reputation. Now, if it is possible to quantify with objective methodology, then perhaps to some extent we can address these issues. What we have done, we have developed the reputation system by including some of the transaction level variables of e-commerce platform. Hitherto, these variables were never considered for developing the reputation system. So far, what has been done, mainly taking the feedback score by the customers. So what we can do, we can identify transaction level variables, and these variables we have considered delivery time, reliability, and of course the quality. Now, another important exclusion that we have made in this study to consider and implement the vision of Honorable Prime Minister of India to have a sustainable and robust startup ecosystem, where we have to ensure that sellers of all kinds receive a level playing field. Earlier, in our government e-marketplace, the GEM platform, where coverage was a variable to consider, and the coverage used to give importance to the larger sellers compared to the smaller sellers. So what we have decided that let us exclude this coverage variable and include the other three variables to develop the reputation system. So it was very challenging because converting the raw data to these three variables really it takes a lot of time. However, we jointly with government e-marketplace could do that. We also collected user feedback and buyer feedback codes and developed a methodology and eventually a model which can compute the reputation score for each seller and which is normalized. So a seller who is dealing with pencils and stationeries and a seller who is dealing with say high-end computers, they all can be provided a score, and now this score can be used for various purposes. Number one, the seller can increase their business, buyers can avoid the informational asymmetry. Now, the procurement theory, due to which explains that due to information asymmetry, two important things happen. One is adverse selection, another is moral hazard. Adverse selection happens before placing the order, and moral hazard happens after placing the order. So what we can do, we can take care of both these aspects. Once the model is developed and the scores are computed, we have validated this model using the data collected from the government e-marketplace. However, we believe that this can be, with the minor modifications, could be extended to all e-commerce platforms as well as the newly developed ONDC, which is at its infancy stage, but we have strong conviction that way forward is ONDC, and even the sellers who are registered with ONDC will be able to provide a score, and this score can be used as a filter by the fintech companies to approve instant and end-to-end digital process for loan approval. Thank you.
Thank you. Thanks, Professor Das. As your study shows, delivery time and quality are important. Cost effectiveness also you have tried to cover, apart from bringing in the trust component, and that's where I think the whole privacy related issues come in, the protection of that data comes in. That I think would be important, and that's what I would very much like to ask Alok in terms of how you see this privacy component coming in, and how you see the point that we were trying to explore earlier in terms of the bandwidth, the cost of operations, and the ability to do innovation.
So thanks everybody. So thanks to Professor Pandya, Professor Lam, So it's firstly it's a pleasure and a privilege to be back here in IIT after having studied at this great. So I have just and it's so quite relevant today from a foreign trade. From I would say increasing e-commerce and then obviously establishes the targets as far as cross-border trade and not the big corporations. These are SMEs. These are small exporters with, I would say, invoice value. We've taken an invoice value of about $5,000. Now, and it's not out of hypothetical cases, day in and day out. In fact, I'm meeting two SME customers again. When you talk to them, they say that we've got this, we send an invoice and we've got this payment. Unlike a domestic piece where it's very clear, we make an, let's say, a X rupee transfer, you get it. On a Forex piece today, even the banks are not clear what they've actually charged the customer for. The customer obviously is big. So I think this is the area of opportunity. Not because I work in this area, I'm setting up a company in this area. But I think if we have to grow cross-border trade in the real world, within G20 countries, we have to get cross-border e-commerce. We have to get our companies to go abroad, which they're already doing. I think the cost of today money moving between, and that's eventually the backbone of trade, has to come down. Yes, today we are trying to solve it through various mechanisms of maybe using virtual accounts in overseas geographies, etc. But what I feel is CBDCs, and tomorrow the fact that there is a G20 organization, and within these countries, if they decide to create some kind of a consortium using a single CBDC rail, then I think there's nothing better than this to solve for global trade.
Thank you. Thanks a lot, Mr. Singh. I think absolutely important. And this is what Professor Bhatia, I would very much like you and Biswajit to pick up. The precise objective of University Connect is to throw up these issues to be taken up by our students, young minds, for further research. And I think Mr. Alokdeep has very rightly pointed out cost of transactions. I think across border is something where those who are planning to do their term papers or any research may pick that up for further research. And that's what the whole idea of University Connect is. It's not just one-day seminar, but to trigger the issues that are important. The challenge for us is also, Biswajit, is that India, Brazil, South Africa, we don't have the luxury of having a research secretariat like OECD. We have our students and research institutions to provide that heft to our decision making. So this, I think, would be important, and the point that you have made, I think, is absolutely relevant here as to how we do that. The CBDC consortium, incidentally, is one issue which will come up, if not in G20, at least in BRICS. And the BRICS is very keen to propose such a consortium in the academic forum we have just discussed. But China is very keen that BRICS take it up, and during South Africa's presidency, we increase that. So I think that's extremely important. Let me now bring in Mr. Amit Tyagi for further discussions and trying to see how you look at the space that are NBFC and other private sector actors require the innovation component for us to enhance the margins that they are operating at. As we heard, and I also mentioned, the UPI's growth is and continuous lowering of margins is also eating away the space that they require for their expansion. So whatever success with UPI would also create a stage for limitations in the margins with which our private sector is operating. Over to you.
Thanks for Chaturvedi, and thanks to the whole IFT community for bringing this event together. I think G20, rather than becoming something that we hear about or read about in the news, sort of comes closer to us. So quickly delving on to what you were mentioning, Professor Chaturvedi, about would UPI kill margins and what else new age players need to do to survive, right? See, I think somebody used the word, not really my quote, somebody saying rent-seeking behavior, right? The system, the infrastructure, and the products that exist today were not built for today's technology, were not built for today's consumer, were not business models that would do justice to consumers of today. The reason why do I say that? Banks today operate on core banking systems, CBS. Were these CBS systems designed for a customer doing 50 transactions of average value of 75 rupees in the day? The answer is no. Unfortunately, this is what we are asking these systems to do today. And when we do that, obviously the cost model doesn't work out for banks. I mean, you can't really blame the banks for it, but unfortunately, legacy infrastructure is failing. Coming to products, right? I mean, today, credit card probably for some of these folks, for some of the students out there, could be an aspirational product, right? But is credit card the ideal credit on-demand product for them today? Ideally not. I mean, we are talking about, we're talking about de-atomization of transactions. That why do you have to pay interest on a transaction you did 15 days back on the last day of the credit cycle and having to pay interest on it or penalty on it if that is not paid? So the fundamental challenge is that the products, the infrastructure, and the processes that we are using today are not meant for today's, age and today's customers. Now, this is the problem. Now, how do we solve for it, right? So obviously, new ways have to come up for it, and that is where I believe that, let's say, banks charging on payments is not the way to go for it. Now, what happens? Again, I cannot do better than quote Mr. Nilekani, who himself says, Indians will become data rich before they become money rich or before they become rich by assets. Now, if as a customer, if let's say there's a customer who runs an informal business and all that they have to show for it is the number of UPI transactions that they receive on a day basis, an average value of, let's say, 120 rupees, but there is, say, for example, 100 transactions. Now, can a bank not look at it and see, oh, there is certain level of certainty to this business? There is a certain level of stability to this person's business. Now, can I not use this data to underwrite this customer for a loan? Now, there are two approaches to it, right? One, the bank say, oh, I'm losing my revenue on these payments that I could have otherwise made. On the other hand, the bank says, oh, I don't want to make pennies on every small payment transaction. What I actually want to do is find a better way to lend to this customer and make more money of this customer as this customer also possesses material. Now, all of us in these schools, we read this case study of sachetization, right? About how this whole shampoo sachetization and it expanded the market. Now, can't financial services or financial products be sachetized like this? Because you couldn't do small loans earlier. It's not like the banks didn't want to do it. I mean, it's easy to blame the banks for it, but the banks wanted to do it. But what was the cost of underwriting? Or what is the cost of, I think we were speaking about trust, right? What is the cost of assessing the reputation of the customer? Very high. What's the cost of KYC? Now, KYC is like, a word that you guys hear about, but is the customer who she or he is saying to be, is she or he actually that person? Now, today, Aadhaar ensures that you can do it in paisa, essentially, hardly touching rupees there. Now, if the cost of assessing the customer's identity, if the cost of underwriting the customer for a particular amount of loan, if that goes down, then suddenly it's very much possible to, suddenly underwrite the customer for a 10,000 rupee loan. Not just possible, profitable, right? So I think that's where new business models will have to emerge rather than, let's say traditional players or even, those of us who've been in the field for a while, complaining about the fact that, oh, our conventional models of making money for. I mean, same thing, right? Today, you can probably do an investment for 100 rupees, right? Earlier, those options were not available that you could hit the equity market for an investment as low as 100 rupees. A relationship manager from the bank would come, take a check from you, go back to the bank, deposit it in the bank. It will have to be cleared. Then it will have to go further on. So look at the cost involved. Now, if you factor all that cost in, how do you even make a 100 rupee investment possible? It's just not possible. But today, verify the identity of the customer. You do not have AML problems. You can take a 100 rupee transaction at no cost. You can submit that transaction forward, and the customer get a 100 rupees set going. Now that's sachetization. That's really what will make money. So again, as the profit pools in this customer segment, they may not be deep, but this is a much wider pool that a lot of players can live in. So yeah, I mean, it's still possible to make money, but you will have to find your ways. Yeah.
Thank you. Thanks a lot for very candid and frank opinion. And I think the new products that are coming in through digital wallets or small ticket loans, I think that is going to multiply. And our estimation is that by 2030, India will be creating far bigger loans through digital mechanisms that are going to come up than the traditional. And this is something which is going to surpass in several different ways. The challenge would be both in terms of bringing in the thin line of sort of governance of the sector, the impact that digital public goods would have, and the amount that a private sector small interventions can create. So that I think would be a major challenge. Let me turn now to Mr. Dhruv. How you look at two questions that I've placed both to Amit and Sarthi, in terms of space that our entities have, and how you see the future role that our entities can play.
Okay. So hi team IFT actually. Thanks a lot for inviting me for this meeting. When I talk about innovations and fintech as a topic of discussion, I would like to actually start with my own story because we developed a lot of innovative products in our company. So we basically developed a deep tier finance product on Express blockchain, in which what we do is we tokenize the invoices released to the large corporates, and then we move those invoice tokens in the form of future receivables, and then these tokens can be transferred by a tier vendor or the aggregator to the tier 2 vendors, which are basically MSMEs. These MSMEs are not able to get invoice finance through banks and NPOs. So what we did is we basically used most advanced technology, which is enterprise blockchain, and kind of blended it with a very chapter 1 of finance, which is time value of money, and kind of built a very basic product of invoice tokenization. Now that's an innovative product, and we decided to file a patent for this product. Getting a patent for a computer science application in India is a very big challenge because the law itself says a computer application per se, for that you will not get paid. So when we talk about innovations, from the point of view of these third parties or fintechs as such, something like patent is very important because you do not have that much of money to start with, and that patents or these kind of innovations, when we actually build up, this is one of the ways to raise funding. So one of the challenges when you are actually developing an innovative product is that how can we actually encourage Indian fintechs to file patents in India itself rather than filing patents in US or EU. Second point is that what we faced was actually to get the first transaction done on the platform, because it was something that banks were pretty hesitant about it. So when we talk about challenges in innovation, especially with respect to G20, and I will talk very specific about India, the two challenges personally I felt was first was on the patent side, and the second was on the getting the transactions live on the platform. In terms of what are the strengths we have, obviously we have a very beautiful stack, which we call as India stack, so that we can keep on building value-added solutions. Funding is not a challenge as on date, because there are a lot of companies, including the government of India through mighty schemes, Startup India schemes, that you can get funding pretty easily now in India. So if you have an innovative product in mind, money is not the constraint. But yes, there would be some regulatory challenges, technical challenges which we have to face. So that part, I think, is what I personally felt, that these are the challenges which I felt, and these are the strengths which, as a nation, we have. In terms of talking about innovations done so far in general in India, I think we can broadly define any financial system into four categories in terms of business use case. One is first one is payment, second is lending, third probably could be insurance, and fourth is the investments. Payments, at least the domestic part. I'm sure Mr. Alokdeep Singh would be working a lot on the cross-border payment. But at least on the domestic part, we are more or less sorted because of two very great organizations. One is RBI, which is managing RTGS and IFPS, and second is NPCI, which is keep on coming up with innovative solutions. Digital lending is growing. There was some backlash with the digital lending guidelines which came up with RBI, but yes, that was necessary. Insurance segment in terms of financial technology is also growing. There is a lot of space as today, which I feel, in the domain of Alltechs or investments, because that segment is, I feel, is not covered yet when it comes to financial technologies. So if any one of you, any of the students actually would look into build up a startup in a financial technology, I think Alltechs is the space wherein you can look for, because that's a pretty untapped market as of yet. Thank you.
Thank you. Thanks a lot, Mr. Dhruv. I think the idea of digital lending and its governance I think is extremely important. And that's the gray area at this point, the amount of apps that have come in and the amount of governance that is needed. And some of them are cross-border. So this requires much more, I think, intervention of MHA and others than of RBI and our regulatory entities. So there are several issues coming up. Fortunately, I have saved a couple of minutes, thanks to my panel, for questions, clarifications, insights, observations, but not long speeches, very quick and fast. So the floor is open now. Anybody who wants to understand the four categories that Dhruv talked about, or the challenges that have been posed in terms of new entities, I think IFT students, I'm sure, will be having several questions. At the moment I open, I will see a lot of hands going up. So I open the floor now, and I hope we have stimulated each one of you this morning enough to have a lot of questions. Do I see a lot of hands? Yes, I'm already excited. Yes, no one here? They are not excited, this group here? Let me go on this side. Excellent bunch of students here. So all four of you, one by one, I think. Do we have mic there? You are good to have a mic if at all they are recording.
Hi, I'm Sachin. I'm doing PhD from IIT Delhi. My research is on fintech lending for MSME. So anyone of you can answer this, pointing to you, starting with. Fintech startup started with the proposition of tech solving the problem of finance. And we see the problem of finance evolving in terms of NPA, misconduct, and in terms of collection. So fintechs are facing the challenges there in terms of problem of finance itself. Then we see the regulatory forcing in terms of that how you will lend, how you will co-lend, what will be the liability, how you see the challenges that the challenges of finance are evolving, the challenges of tech are evolving, how fintech startups can take this as a challenge or opportunity to solve the problem, or will it hamper the growth of innovation?
Good, thank you. And that next one, we will pick up 3 more questions.
Okay, so my question is, Mr. Amit, regarding the new business model, one thing is that there's less margin for private sector while all the predominantly services going, but at the same time you have very rich data, right?
So what you are trying to do? One of the things I'm better with a related offer from Google Pay, right? I hope some of people will come with, they look at that transaction, they should come with a relevant offer, right? So how you are trying to make sure that user privacy is maintained, at the same time, new business model is coming up, which is relevant to the user. Thank you.
I think they put one more hand. Yeah, yeah.
Yeah, good morning. So my
So
dissertation
please
is
do
on.
mention about the course and the your introduction, and then if you have anyone particular in the panel in mind.
So my name is Sana. I'm doing my master's in economics from IIT, and my question is to all. Anyone can answer that. So currently, I'm doing my dissertation on fintech and credit rationing. So we have seen that fintech is reducing time for approval of loans, and various cost-effective techniques are being innovated, and also due to digital transactions, the use of people can be traced. So particularly, what will be the effect of this evolution of fintech on commercial bank lending rate and credit rationing in particular?
Very good. I see one more hand. Right. This side is completely silent. I don't know what is wrong here on the right. Left is very active. Yeah, please.
According to this, Lalit Kumar, I'm doing my degree course in finance. My question is, when you talk about innovation, we can't shy away from DeFi, decentralized finance. So I just wanted to know how accommodative are the regulators in this space? Do they see it as a worry or an opportunity?
Good. So I still do not have anyone on this side. Biswajit, you are leading that side. Anyway, so let me come back to my panel, and we would start with Sadhguru Rajaz. Can you borrow your mic and then I think I would just go around the panel if anyone wants to respond.
So I guess your question was how fintechs can actually help MSME lending, if I'm not wrong, and how we can probably reduce the possibilities of NPAs, which happens, especially when you are lending someone digitally. So one of the ways which we did in our organization is that we do it through something called as investor organization, what we talked about. Because a lot of MSMEs in India are not direct suppliers to the large corporates. So most of the MSME manufacturers generally they supply to some tier one vendors or the aggregators, which then do some value add and then they supply to the large corporates. So although we can see that there is a chain, they are actually a very important part of the overall supply chain. But since they are not supplying to a good credit rating anchor, we are not able to give finance to them. So what we did is with that we brought the entire supply chain on a blockchain ledger. The invoices raised by the tier one vendors to the large corporate, we tokenize those invoices, and then the tokens can act as the future receivables. Then these tier two vendors, which are actual MSMEs, when these tier one vendors actually raise invoice to them, the future tokens can be further transferred to them. What we have done is now, hello.
Yeah.
Hello. So this actually answers your first question, is that how you are actually infusing those MSMEs. One of the ways is to that use the advanced technology to bring them that they are part of the supply chain and they can get finance through innovative solutions. Second, about reducing the NPAs. Now, what we have done is actually we have now the burden of payment has reduced from the tier one to the large corporate. And these large corporates are generally A-rated companies. So the probability of default actually also reduced further. So if you have something innovative in your mind, so you can probably build some unique solutions wherein you can actually reduce NPS significantly, as well as reach those segments in the society, those MSMEs, which actually traditional banks are not actually being able to do.
Thank you.
I'll just quickly try to kind of type on all the questions. I think the first question was more around the lending business model. Again, I think technology can change ways of doing business. Technology can help you do existing business. It can always add new business models, but lending has been going on for centuries. As we love to say in the industry, it's not about giving money, it's about how well you can collect it. So if you are lending on unsound risk models, you are bound to face those problems. That technology is not the silver bullet for that. Sorry, I'm just going to kind of keep this short. I think the other question was from the gentleman who was fed up of getting unrelated offers. Again, theory comes into practice sometimes. Big data meets customer behaviors, gives more relevant offer. Obviously, you have to balance this with what Professor Chaturvedi was talking about earlier, privacy concerns. So I think regulators and industry bodies will have to play a more stronger role. But yeah, from an industry participant, I would rather say that as a customer and an industry participant, it is better that the customer, rather than being spammed, gets something much more relevant. Today, technology is available using that with Big Data. I think there was a third question around commercial banks. I cannot speak to commercial bank, but the lending business model is fairly simple. I'm going to be extremely simplistic about it. There's cost of customer onboarding, there is cost of fund, there is cost of NPA. There are three parts to effective lending model. If the cost of customer onboarding is going down, if the cost of funds eventually go down, that's more monetary policy than anything else. But lending to SMEs will always have economic cycle. So NPA cannot go down to zero even in an ideal world. So yes, some costs will go down, but for SMEs, it will be business cycle, monetary policy will determine what cost of funds are. That's not going to change much. I think the last question was on DeFi. I cannot pretend to speak for the regulator, but I prefer that the 2000 rupee note may not be a good example, but I prefer that the 500 rupee note that I have in my pocket retains the 500 rupee value when I wake up tomorrow morning. So I think DeFi has a lot of promise, but there is a long way to go because anything can't be catered to a 0.0001% of the market. There has to be enough of a fast market for these products to collapse. Yeah.
Thank you.
I think you covered most of sort of the priority satisfying to talk about. The DeFi, if we can start with the last word, that's what it is. But the way things stand is obviously crypto is a word people don't want to hear at this point. And the fact that to the point that we made, there is a 500 rupee note and you wake up to. So when the whole aspect about DeFi is it takes away, you decentralize finance, maybe with blockchain and other things, there can be some control, but then it also takes things around a particular point that and nobody has control over it. So I think the alternative to something like DeFi could be from a wholesale perspective. So I don't know what innovation can be done at this point on the domestic payments or the domestic retail payments per se. But I think CBDCs have a great future from a wholesale banking perspective and specifically for being able to enable trade. So wholesale banking, because obviously there's one big aspect of sustainability which nobody
चलो बाबू जी खत्म हो गई मीटिंग।
Stability. But if I can add, this is an interesting paper which BIS and IMF have released, and they have identified 19 building blocks for CBDC. The challenge for CBDC are at two levels. One, there are too many financial intermediaries, and as a result, settling of CBDC is a major issue. So what they have suggested is to have a single platform across the border for settlement of CBDC. I think Mr. Amit Tyagi made a very interesting observation, and I think again he was far more interesting when he was responding to questions, and he said about cost of on-banking sort of landing that we are going to come up with, and that probably would be something extremely challenging for MSME, though it is to be dovetailed and contextualized in the framework of the monetary policy, because that's where the issue could come up. But I think here, as we are expanding to several areas, cyber resilience, I think would be absolutely important for us to go forward. The products of digital wallets and as I was mentioning, small ticket loans are important for us to introduce new products backed by adequate technological solutions. Mr. Dhruv Bajaj's points were very interesting, and I think the twin challenges that he raised, first in terms of the patent-related challenges that he mentioned, and second was also in terms of finding out a platform for the first transaction to happen. So these, I think, points have come up, which probably would have Vishwajit huge relevance for G20 discussions in the finance track, and I think are also important for some of our countries' best brains like Mr. Jankiram on technological solutions that are visible. And I think If our entities can get access to those technologies, overcome the patent-related challenges that we have, I think G20 should give a call in terms of a sort of moratorium on some of these patents, or buy them out, or evolve some mechanism to have open sourcing as one of the possibilities in the fintech. So with this, I thank my panel, a big hand for them, and thanks to Mr. Leith and Dr. Tuhina. I haven't taken any minute more than 11:20. So thank you.
I thank Dr. Sachin Chaturvedi for moderating the panel, and the panelists who have come all the way from us, and panelists. Now we would like to ask Mr. Oki Bani to felicitate the panelists and the session.
Good. Thank you, Dr. Vivek. Bye. In-house. Thank you, sir. Thank you. एक फोटो के लिए फोटो कैमरा अरे आइए आइए हाँ ये Thank you.
Thank you so much. It was quite amazing. We break for the high tea, and we gather here for an extremely interesting lecture from one of the stalwarts in India who is working on fintech, is Professor G-20. So we'll gather here, we'll start the lecture exactly at 11:45.
मैडम कल बताना था आपने जो आपने कितने टेबल पे कितने बताए आप 4 5 आप
run going to make a huge difference in terms of how the whole financial ecosystem is likely to be evolving, some questions relating to MSME funding also, I think the answers lie in actually looking at the account aggregator systems, which is quickly evolving with the RBI, taking a very important lead in that. The other important thing that has actually happened is what we call as a tech fail. This is a word that is quite some time back in early 2014 by the most Chinese the platforms that actually tried getting into the platforms trying to take the approach of financial services as a means of improving their platform, social platforms. This is called a platform approach. I think what we've seen in this is there are network effects and extreme scaling that is possible with this. In fact, the kind of scaling that they have achieved is something unbelievable. In fact, what is actually called as the super apps, is something that in India we still not exploited. For example, can the UPI become a super app? It's something that we have not looked at yet. But the super apps have the ability to actually make the embedded finance, which means that payment becomes a frictionless way of integrating with other services. It is something that the app will take care of lots of things. This is a model that was exploited. One example of this extreme exploitation is WeChat Pay. Alipay and WeChat Pay are real monopolies, what we call. They started capturing the entire market through data exploitation. What really happens with the super app model is a lot of things relating to the customer will get embedded into the app, and that will lead to extreme exploitation of the data that is available. One example of this is what actually Ant Group tried doing. Lots of things which happened with that group, but then I only focus on this one aspect, which is critically called the 310. This is 3 minutes for a loan app for filling your application, 1 second for giving the credit to you, and then 0 human intervention. That's what they achieved. This is called the 310 model. With this, they had extreme unparalleled credit expansion. This is dangerous because the default rate with this model was less than 1%, which means that they have really cracked the credit problem of giving credit to the right people, letting them do what they need to do, and that was a phenomenal growth in terms of the economy, right? The minute actually the credit reaches the right people, it's going to really open up the economy for the growth, and that's I think something that was cracked. But then this unbridled credit expansion is certainly something that everybody will see as a threat to the financial stability, because there's so much of concentration that is happening within these platforms. They suddenly look at a financial stability problem. And we all know what really happened after that. The crack on most of these groups, and then things are really being actually taken off. I think this is a lesson for everyone to learn. If the private models come in, they can bring in this extreme level of scaling, and network effects. Same thing happened with Facebook, which ventured with what we see as Libra, the digital currency, and then with again extreme resistance from the regulator, they watered down that to dime, and then that also found a lot of resistance, eventually leading that project to be shelved. What all this point out is this this model, tech-fin models, where the big techs can enter into finance, but then it could be a big threat to the financial stability, something that I think whatever has been practiced for a few years in other countries, certainly there are. What are the kind of model that I think India has developed for the financial inclusion? I think this is now popularly known as the right, what we call as let me go down, because I think there is I think I should come down from the stack. though it's actually showing, the animation is showing from the top, I think it should actually come down. The Indian tax model is defined by what we see as Aadhaar, large biometric database that was created. That's an engineering challenge of its own, more not from technology point of view, more of social aspects of social engineering of bringing the people into such a system. I think the key thing that has happened with that biometric database was Aadhaar became Aadhaar for opening lots of things, including the bank accounts that we are all aware of now, the PM Jan Dhan accounts. Now I think we have probably the fastest financial inclusion with this identity creation, with 40 crore bank accounts being created in 9 years and almost 1 lakh crore deposits being done into these accounts, is something that is phenomenal growth in terms of how the financial inclusion has actually happened. Connect this with the mobile, I think this became a trinity, what is popularly known as the GAM trinity. The access to mobile as an interface to the digital infrastructure has really opened up a massive opportunity for the entire country in terms of how to deal with this financial inclusion. This is what we see as a public good infrastructure, which Professor Sachin Chaturvedi also mentioned. And RBI also mentions this in the models of how things have happened for the country. So what we have done is we have actually done a public good infrastructure, and this is something that the government invested. It's basically government investment. And same thing happened with the UPI. If you look at the UPI, it is just simply a creation of the bank account handle and then allowing the payment infrastructure in terms of moving from one handle to the other handle is something that got created. And over that, basically the private innovation was allowed. That's where basically we started seeing Google Pay and then WhatsApp Pay and quite a few other things getting developed. So the India model was the basic infrastructure will be public infrastructure. This is also called the public good infrastructure. I think this is a very important concept of the Indian ethos from a very long time, where basically education and health are actually public good. So we actually subsidize quite a bit of health and education. In a similar way, the digital infrastructure, which is a public good infrastructure, should be invested by the government. That is something that the government has done as a model, and the private innovation is actually allowed to work on top of it. This is the model that seems to have come up very well as far as the so this is what we call as a public good infrastructure. Internet is in some sense probably the public good infrastructure. Lots of things have happened on top of internet. The model is not new model. The model is basically something that already existed. But I think this is something that we have So in some sense, UPI as a private infrastructure and the other payment private payments as a thing has its own flip side. For example, we still need to watch out how the Google Pay is going to expand. For example, the AI ML models they use and then what kind of financial services they bring into the platform and all those, because they still have the ability to with 230 around million users, I think they're quite powerful in terms of what they can do with their platforms. The other important platform dynamics that was also created recently is this open network for digital commerce. It is also popularly known as ONDC. But ONDC is somewhat different from the other public good infrastructures we have created so far. ONDC is based on what is called a standard protocol, backend protocol, which is actually a protocol which is implemented as part of the ONDC. Now, what is great about that approach? That approach is if you actually make it protocols and make these open standard protocols for your digital infrastructure, then it is possible to actually make these infrastructures interoperate. And then a global interoperability of these platforms will be possible. That is when actually you get a true global leadership. If you're able to reach that point, possibly, there is sure of some kind of a space, going forward, and the G20 certainly can, learn from this model, and then India's stack model certainly holds promise for large-scale adoption across the G20 countries, given what has happened with the other model, in my opinion. This is something that India should focus, the world should focus, G20 should focus. The other important going forward, I think, the next interesting thing, probably some of the things I'm going to skip given the time constraint. But I will certainly focus on this KYC problem, The know your customer problem was highlighted when I came to IDRBT for the first time from IIT Madras. This is one problem that attracted my attention, and it still remains to be a big problem. Okay. All said and done, KYC is the biggest pain point for the customer. This is introduced mainly because there are bad apples in the system, and to actually weed out the bad apples, you have to check on every good apple also. So this is basically the KYC is that don't trust anyone. It just turns the whole problem in a completely different aspect. And then there should be AI and ML models that could be used to reduce this pain point. One of the things IDRBT has started doing is what we call as blockchain and machine learning powered unified video KYC. And this is, fortunately sponsored by the Ministry of Electronics and Information Technology. It's a consortium project with RBI Innovation Hub also being part of it. I will not go very deep into it, but what I say is eventually the system, if it is built, it becomes, the digital identity platform with the digital trust and digital privacy, which is very, very important. I'm not going into those aspects, but then that forms the basis for building any digital, financial infrastructure for the country when the system is actually rolled down. Not only this, it becomes a basis for all the regulators to trust each other and the process to become a transparent process as far as the customer is concerned. So what it will result is the customer just doing one KYC, as illustrated recently in the budget speech by the Honorable Finance Minister, and they will create this system integrating all the elements of the digital infrastructure to ensure that the customer needs to do one time with KYC for the entire financial system, and then when repeated requirements are there, they basically are flagged by the system itself to you. This is an advanced stage of implementation as far as the project is concerned. There are very few people who are involved in this project. I will not go deeper into this except saying that the blockchain gives you the digital trust, and that digital trust that is required across various parties involved in the financial system. And then the AI ML will give you the required privacy that is needed for the system to make sure that the data is not compromised. Especially with the data protection bill in the offing, I think it's very important to protect the customer data. From know your customer, the mindset has to change to protect your customer. I think we are actually far from that. I think people are being exploited with their data. So what is most important is the mindset should change from know your customer, thereby exploiting to protect your customer and protect this data for the right users. There should be a complete change in the thinking as far as the digital platforms are concerned. This is a very big important issue, and I think I won't go into deeper at this point on this, but then I just the remaining 2-3 projects also, which I felt are important projects to mention here because they could have far-reaching, implications as far as the country is concerned. The first one is the, for the last mile connectivity, what we call as a LoRa network, a low-cost financial transactions network, This is, in our opinion, a very, very important network. This is basically uses the LoRa, which is a low power chip spectrum for transmitting the packets. And this is very easy to create this LoRa network. Any district, any financial district, you can easily put up this LoRa network. I'll just show you quickly how this is done, and then what kind of advantages that one can get for the last mile connectivity using the LoRa network. The other important innovation that IDRBB is pursuing is this mobile private 5G edge cloud. This is something that with the 5G, actually, with the network slice component of the 5G, what you can do is you can install a bank in a virtual box anywhere and connect it to whatever data centers you want to the backend. And it is possible to do this in a disconnected operation, which means that you can suddenly create a new model of how banking can be taken to the last mile using the 5G. Both these models, in our opinion, are very critical innovations as far as the last mile is concerned. We believe nobody works at the last mile because there's not much money in that. That's the biggest problem. In India, all innovation happens where there is money. The first question they ask is public good innovation. Generally is not taken to the level it should be. Both LoRa and this private 5G, we believe, are important components of the last mile. In fact, what you will see is in this picture a very small device. You can see that this LoRa can be made with less than 10,000 rupees. What we have made, and if you scale it out, I think it will come down to less than 5,000. And the entire district can be covered by about 5 LoRa devices. Okay? Which means that about less than ₹1,00,000, you can set up a private connectivity, which can be used for transactions, for micro transactions. What we are doing now is we are working with the objective of actually connecting the rural areas. We have picked up a place in Tamil Nadu, Tamil Nadu Gamma Bank, with two places where basically no other connectivity is working for them. And in fact, we are setting up this connectivity to actually make sure that the entire bank can be connected in real time using this LoRa network. This pilot is on. This pilot is being done with Tata Communications, and then TCS is also involved, and then a micro ATM provider is also involved in this. And I think this whole POC should be ready by the end of this month, and then this will be available for any banks to adopt this kind of a network. What I see is the most important thing is when you look at cyber security, the threat actors are not limited to just the country. They are just across anywhere in the world, because the minute you connect your system to the internet, you are basically having the cyber security issues, threat actors that come from all over the world. With this LoRa private network, you will set up a network that actually doesn't require power because you have battery. That's what Professor Chaturvedi is also mentioning. Once you put the battery for 5 years, you don't need to touch this device. Hopefully, some maintenance may be required. We will try all this out. So a district with about ₹1,00,000, with the battery put in, you will have an emergency network any point of time, because the transactions can go through this private network to the core banking of the bank. And nobody else will have access to this, except unless somebody sits there and then start listening to this packet, going there physically to the place, and then start tapping these packets. So in some sense, this is a very interesting project to have, and India can easily put up a low-cost financial network, which is different from rest of the other things, right? I'll not again further go very deep into this, what we have done and what are the technical details of this project. I think if you're interested, please do come back to me, and we'll be happy to work with you on any of these projects that I'm mentioning. The other one is basically 5G. 5G is always being seen as a something that powers your mobile with a lot of streaming data. So what is really not possible earlier, like the AR, VR, will be possible with the 5G. What I think is there is an entirely new angle to the 5G, which we call as the 5G edge. What we provide is a multi-access edge cloud, which connects to the private cloud, which means that you can take the data to the edge, do all the required analytics at the edge itself, and you can power lots of things from the edge itself. In fact, to do this concept, we call this back on the edge and back in a box of the thing. We have actually virtualized the entire 5G infrastructure, and then push this to a WAN, which means that the entire 5G is set up in the WAN, the entire edge cloud is set up, including the G-Node D and then the core, which will be running in a WAN of the mobile WAN. And then from there, the edge service can provide, the 5G can be provided as an edge service, which means that when the mobile goes to a village, it can provide the 5G services. Now, with the edge cloud, you can create a bank in the box, which when it actually gets connected to the backend, can seamlessly transfer the data. It means that the bank infrastructure, the disconnected part and the connected part get connected by the 5G slice. Okay, so you get an excellent concept for the bank in the box using this. In fact, this was actually demonstrated, and we have actually got this 5G edge cloud set up now at IDRBT. You can see the WAN. This is the WAN that was given by Union Bank. They were not very happy that we removed their logo from this. But now we have an innovation center from them coming to IDRBT. So I think we would be putting their logo again back. But then this WAN is suddenly available, for trials and all that, which we are actually looking at now, taking it to the next level. I think when all these elements come together, I believe what we will have is basically a national digital financial infrastructure. But very few of these elements have to come together to create this modern digital financial infrastructure. I will just do this and then stop here. Lack of not running out of time, right? But this is very, very important in my opinion. If you look at the basic problem that we are undergoing now, is in terms of the data. Once you want to exploit the data, then the data needs to be centralized. That's where the private models are actually collecting the data and using it for the AI ML, and then trying to exploit that data is something that the private models have actually preferred doing it. That's where the platform economies are coming in. Now, if you look at data which is in silos, if it needs to talk with each other and create the framework by which the data helps doing the right things, I think that's where basically we have an issue, right? To make the data talk to each other, we still need to solve that problem because data is lying in silos. If we are not actually allowing platforms to actually exploit that data, right? So given this, I think we need to actually figure out, and the model that we are looking at is a federated learning model. Now we are building a different kind of a model in this particular case and choosing those distributed models, and also looking at what we call as a homomorphic encryption. One of the key things with data is, when it's encrypted, people don't mind you taking anywhere. For example, the very powerful General Data Protection Regulation, which is called the GDPR of the Europe, doesn't will allow you to take the data out if it is encrypted. So the key thing is, can I run some functions on this encrypted data and get the result encrypted so that I don't really need to worry about sharing the data at a central location? This is something that's worth actually pursuing, and a lot of if any of you are actually, there are a lot of students, I think it is worth actually even training data on encrypted data. That's a very interesting problem one can look at. For example, I don't compromise the privacy. I train my model with the encrypted data, but does it still work? Okay, these are interesting questions to ask, because data privacy is integral, and we don't want to compromise on data privacy and exploitation of the data going forward. If that is a very sacrosanct principle, we need still some miles to cover before we come to the right solution. I think with this I will stop because I think I suddenly ran out of my time now. I guess I think going forward, what I believe is data privacy and integrity and responsible use of common data for AI/ML is a general concern of all of us, I believe, and we should certainly look at that. I think G20 as a group, I think is well positioned to actually look at responsible use of AI, which is the need of the hour with data privacy. With these few thoughts of mine, thank you very much once again for giving me this opportunity to share my thoughts with you. Thank you.
Thank you. That was really informative. Insights we never knew were possible. So it's very heartening to know all that is being done and the potential of the stack model and how we can architecture. Last mile. Thank you so much. Dr. Mukherjee, do we have time for questions?
Yes, no, but we can have one.
One question. Yes, please. You have a mic? You can take it.
Sorry about slightly running.
Thank you. My question is regarding the responsible use in terms of data sharing, data collecting. You said a shared network in terms of data sharing and client data, then you can have a shared understanding of the protocol regarding the data. But when we see in terms of business models, data-driven business models, they have value propositions lying in the data itself. How do you see that from the customer point of view, or I will say the citizen point of view, when I'm very concerned about my data privacy, which is integral, and then there are like businesses which are basically running on the data, creating value out of the data. How do you see the responsible in terms of pro-social and pro-organization point of view? How do you see the role of technology increasing that together? Thank you.
Yeah, I think very, very important question. And then this is something that I believe again is a very fundamental question that we should answer. One is data exploitation, of the user at any cost should be avoided without his consent, right? So given that position, I think in my opinion, that's a position that we can't compromise, Now, all the big platforms, what we call as the time, Facebook, Apple, Amazon, and then Netflix, and then Google, or even the Chinese models, private models that actually came out, they actually exploit your data and then try to actually sell something to you. So in some sense, they're actually taking your data, making use of your data to sell you something. So that's where their power lies, right? That's where they're able to give you, lots of things for free because they actually, have the business models for something else, But that suddenly is a cause for concern. The minute you get into a decentralized mode where the data lies in these silos, but it still can talk to each other with the consent of the user, that's where basically you start seeing both benefits coming as per the customer's requirement rather than as per their requirement, And I think that balance has to be set in now. The key issue here is, in my opinion, making the data talk to each other. One model that we have put in place now is these account aggregators, but it's still not friction-free. You need a friction-free customer level, ability to share his data as he requires, for getting, for example, you want loan. At that point, you want to share your data and then make sure that you have the best ability to, get your loan. But if he gets the data and starts exploiting for a lot of things which you don't really need, that's where basically the problem lies right now. Okay. Hope I've answered your question. Yeah. Thank you.
Thank you, Professor Sanjana. We are now having on stage Mr. Jaydeep Mukherjee to kindly facilitate Dr. Hari. The next in line is the student presentation that we have from IISc. So our students are also working in this area. So may I now have the student presentation by Ms. Nidhi?
Good morning, distinguished guests and all the members. And dear students, it's my pleasure to stand before you and shed a light on the global fintech. My name is Neetu. I'm a research scholar in mathematics from finance business. Fintech and global finance, fintech and the future of global finance has an important and significant role in G20 members. The G20 acknowledges the fintech and the future of global finance hold significant importance. Fintech can help bridge the gap in access the financial services, particularly in developing economies. So my presentation will start. So my presentation spans through the following heads. And defined by the advancement of technology, the financial services, and the new products and services. It is that the ongoing digital revolution is the traditional model and factor global innovation and foster global innovation. In terms of the number of one startup, followed by the AMIA with 9,681, and the Asia Pacific with the 5,061. The United States also dominates the fintech unicorn position with a 105 unicorn, and followed by UK with 27 and India with 70, indicating their prominent position in the fintech industry. Fintech regulation and approaches in the G20 nation. G20 implement regulation like regulatory sandbox. Regulatory sandbox provide a space, safe space to the fintech startup in which they can test their new product, new application without fulfillment of all regulatory requirements. Whereas the fintech hub and innovation centers provide support and the fintech. G20 members also provide on the banking and regulatory collaboration, blockchain, regulation. Some examples of Indian fintech startups are UPI, Digital India, Pradhan Yojana, and the regulatory sandbox for the financial inclusion. India's fintech market has experienced remarkable growth aligned with the global trends. With the 24 unicorn startup by the July 2020, these startups took an average of 4 years from the series of 8 and to reach unicorn status, securing an average of the funding of $157 million, and ongoing through the 6.3 funding round with the 12.2 institutional investors. The total fintech funding in India reached around $30.2 billion in June 2020. Globally, there are 266 fintech unicorns averaging 4.4 years from the Series A to unicorn status, with a $168 million average funding before the becoming unicorn status. As you can see in the figure, the diversity of fintech landscape ranging from the play tech, land tech, digital banking, insurance banking, and the wealth. Key drivers for the growth of the fintech sector are the business environment, technology, and the talent demand growth in India. Favorable business environment include economic growth, a large unbanked population, including unbanked population, government initiative, and improving internet access. The growth is supported by the rising disposable income, expanding young adult population in India, penetration of smartphones, and the private e-commerce marketplace in India. The major challenges fintech industry faces nowadays are related to geopolitical volatility, data security risk, regulatory updates, low financial literacy in India, and wider adoption of overbanked and unbanked segments. Geopolitical uncertainty impacts global expansion, data breach and data breach, balancing innovation and customer protection is a crucial regulatory for the regulators. Limiting participation of fintech clients and the rural area. The pandemic has accelerated digital adoption by the MSME, but technological adoption varies between the rural and the urban area from the consumer. Understand reason need more infrastructure and integrating challenges. Industry must address these challenges related to the geopolitical, data security, regulatory compliance, financial education, and infrastructure development to promote inclusive growth in the industrial in the Indian fintech industry. Conclusion and features. Global and Indian digital fintech along with the government program, high internet penetration, regulatory support, and the growth of MSME, given the expansion of fintech. To ensure the fair competition, market concentration issues, and the data misuse by the big tech companies need to be addressed. Regulating new entrants and decentralized system poses challenges that require international coordination. Digital adoption fosters financial inclusion and education. Advanced technology like AI, artificial intelligence, machine learning, APIs, and microservices offer hyper-personalized, evolving economic business model aim to enhance customer experiences while embedded finance enables the integration of financial products into non-financial service through APIs, expanding access for the customer. I'm going to conclude this presentation with our quotation like, together let's harness the knowledge, drive change, and shape a secure, accessible financial ecosystem for all. That's all from my side. Thank you.
Now we have the last panel discussion for the day. This panel discussion is focused around fintech regulatory frameworks and strategies. May I request Professor Bhatia to please come up on stage as session chair of this panel. Professor Sarita Bhatia is a professor of finance, dean academics, and currently the vice chancellor of Indian Institute of Foreign Trade. She has held key responsibility and leadership positions at the institute, steering the institute to new directions. She specializes in the area of finance, financial management, financial and management accounting, equity market analysis, bond market analysis, fixed income securities, and international financial management. We also have panelists for this session as Professor Vishwadeep Lal. May I request Dr. Lal to please come up on stage. We have Mr. Sandeep Mehra. Sandeep is a law graduate and a company secretary. He also holds postgraduate diploma in international business strategies from IIT Delhi. He has over 12 years of experience in handling corporate finance, corporate legal, regulatory compliances, and commercial functions across various sectors. His expertise lies in advising multinational companies on their India entry strategy. The next panelist we have Dr. Sriram Virudavelu. May I request Dr. Virudavelu to please come up on stage. He holds a PhD in Open Innovation in ICT, conferred by Indian Institute of Foreign Trade in 2016. He also has a master's in computer science and bachelor's in electrical engineering. Currently, he is the CEO of DFCI, Cybersecurity Center of Excellence, a NASCOM initiative, since 2018, incubating startups in cybersecurity and privacy, and running programs in research policy, corporate innovation, collaboration, incubation, and capability building, and hackathons. The last panelist we have today is Mr. Harpreet Singh. Mr. Harpreet Singh is the founder and chief executive officer of F2 Fintech. In his current position, he takes responsibility for F2 Fintech's strategic direction and growth. He brings more than 7 years of experience and global history to the company, and previously held the role of managing director and CEO at Financial Freedom and Insider Lab. We welcome you all as for the second panel. I request Professor Bhatia to take over.
Thank you, and welcome to all of you for this session that we will currently have on the regulatory framework. So the way I was thinking is that I will have a few questions on the framework and the strategies which the players over here adopt, and maybe you can give very quick views on what you think regarding those issues that I would face. So talking about fintech regulations, sometimes people wonder why specifically we must talk about fintech regulations. I mean, there are regulations for all financial services. And so if there are some entities that are providing financial services, they should automatically come under the current regulatory framework that would be there. It should not be that some entities trying to imitate banking services and then say that we do not want to come under the regulations that govern banks. So UK has got some very nice framework in the sense that they do not say that we are going to have any special regulations for the fintech sector. So if you are providing a financial service, you will automatically come under it. Of course, regarding the use of tech, again, they say that there are rules that govern the use of tech, maybe even data sharing, etc. So whatever rules there are, those rules will also apply to you. So I will request my panelists to first give their views. Do you think India should have anything specific governing financial regulations? So maybe we can start. Please.
I would like to thank Mrs. Bhatia to extend the invitation and call me here between all you young guns who would be taking this fintech industry ahead, as it is a new industry and
we all are going good with this industry, and when we see the young guns coming into this industry and bringing new thoughts, so it is also creating more of a baggage which we are taking as a traditional banker. So what problems we are facing as a fintech company, I would discuss with every one of you sitting here. So if we talk about the framework of fintech, it is majorly divided into three parts. First is the activity-based fintech, then the entity-based framework, and then the outcome-based framework. So in activity-based framework, we talk about what kind of activity the fintech company is into. Then the entity-based fintech is what kind of entity is it? It is a payment sector, it is into lending, it is into PPIs or whatnot. Then we talk about the outcomes, that what outcomes we are expecting from the fintech company, what kind of technological things they should see, that it does not take it as a toss for the bank or the traditional system. As we know, there are more than 35 banks and more than 10,000 NBFCs in India. So they would be having different products. Now they are having two teams. One is the direct team and one is the indirect team. So the direct team is the people who are working for the banks. They are the salaried employees of the banks. Then there is an indirect team for the banks. They are the DSAs, DMAs that are supporting the business for the banks, that are loan originators for banks. Now fintech companies into the same space as an indirect team. They are not having the hold like the banks are having as per the RBI. They are not being controlled by a uniform party. So once they are not controlled by a uniform party, so there are different bodies who are tapping them. So maybe RBI is tapping them somewhere there IRDA is tapping them, somewhere SEBI is tapping them. So there are different regulations or different authorities who are tapping them. So the fintech company as an owner don't know that which body would come up to me. Like if you see UPIs, we are having 40% of the global transactions that are happening. So out of the 100% transaction, India is holding 40% of the total transactions that are happening. But if you see the major factor of BNPL, if you have heard about it, buy now, pay later. So they were earning, if I talk only about one company, LazyPay, they were earning around 35 crores a year. Out of which 25 crores was coming through the different things which government have now stopped at all. So as a fintech founder, we also need clarity on the regulation part, that if we grow big, then somewhere RBI is behind us, that this is a big fish now in the market, let's catch hold of this fish. So as a fintech founder, we also need few clarity that what kind of regulations will come up to us, what kind of regulation will bind us, and at what stage it will come to us. That's why.
Hello. First of all, thank you very much for this wonderful week and forum. IIT, especially for the and all the distinguished guests here. So, my comments on this specific question is that India should certainly develop its own frameworks for regulation. We cannot, just because some country has opened up cryptocurrencies, we can't do that. And I will give casual comments, it's not like a master class or anything. I have been to blockchain conferences in which there were stalls where they were selling glossy brochures outside, which are not cryptocurrencies, but derivatives of cryptocurrencies already. Okay, highly risky. We are taking so much pains to even control this. I mean, the funds that how people withdraw from PF, provident funds, and all those kind of things. If we just let it loose, and there will be very big, sleazy also salesmen out there, and there will people will in fact borrow money or sell their plots to invest in cryptocurrencies and all those kind of things. There certainly need to be regulations because of IPs are not. So that is one aspect of it. Secondly, the second aspect is that again, If one can get food and one compares which on the TV, read newspapers, you go out and do a lot of research and say that Amazon is doing this, somebody else is doing this and all these kind of things. We need to understand that what scale they are. They're planet scale companies. In fact, okay, that means they can easily turn on some taps of data and monetize. But the fact is they don't want to monetize that. Until 2016, Amazon did not wasn't even proper. They don't care about it. They want knowledge. They want to know what is every citizen's mind is, everything is. They want complete control. And investors are prepared to wait because some of them are enormously wealthy countries. You cannot compete with them. In fact, they are bringing out models like, for example, in Amazon, you have normal models. You shop and they ship. You shop and they ship. You shop and they ship. They reverse it. They will ship and you shop. They are experimenting with that also. That means they know your behavior so well that whether you need shaving bread or something, they ship it, they are willing to even undergo losses also if you don't want it, keep it also. But they want much. So in that sense, in every aspect of it, even if you take energy aspect of it also, you certainly cannot have people driving SUV cars for 5 kilometers, 1 mile, or whatever they say, and eat a sandwich. That's not sustainable for us from an energy point of view. We need to evolve our own solutions, which should be really specific to us and it's solve our problem. UPI, all the ones which Dr. Jankiran mentioned are wonderful examples. I will just give you a small mistake that when I was in Oracle, I used to buy a lot of companies, and almost one company a month. And there are a lot of companies in Germany and all this, they were excellent to look at financial models and everything they bought it. The moment it became a Oracle, they tried to deploy it in India and it failed and bombed. They really, in those countries like Canada, Germany, they never had 1 million hits in 1 hour and all those kinds of things, and with so many multiple languages, and they have to re-engineer everything. So we need to find the low-cost, scalable solutions and all. So some of the things is we can take advantage of some of the problems which Professor Jankiran mentioned, saying that how do you restrict access while not allowing them the customer experience. Web3 was built for such things. So you can take advantage of those things wherein you can log out. So to give an example, let's say some fintech in healthcare space is coming up, and then it has one of the problems. There are many touch points at the time when they sell the instruments to the patient claims the money because it is collected in hospital to various things, right? How the money is going. So even at the time when he is filling out an application form, when they do verification, supposing your data is patient data or something is there in a blockchain or something. You can selectively do it so that you'll unlock it for a specific purpose. You've given consent for a specific purpose. And then that you do it, and after that it expires, then your data is out there. So that again, when the hospital also visits, it is there. To make money, then I was talking about data science insurance sector. So in that manner, you need to evolve frameworks so that you are able to manage the privacy problems and all those things. And since it is so much fine-grained at that level where evolving transactions from one can strongly consider microservices and cloud. Again, we need to impose certain things. For example, in the cloud, there is the 4+3+2+1 model, in which it says that your data, the backend needs to be stored on at least 4 sites, 4 different places, at least 3 different sites. That means 2 of them can be in one site. And of course, in 2 different types of devices, 2 different types of media. Okay, and one of them compulsorily is on the cloud. These need to be there because to guard against hacks, to guard against all sorts of practices. Let's suppose it is one data or the practice manipulated or something. You need to put in these kind of restrictions or rules. Otherwise, we will suffer as a nation. Okay, so that's a short answer for forward. There are so many aspects that I thought.
Yeah, we'll come back.
Yeah,
We'll come back. Quick view.
Good afternoon, everyone. First of all, I would like to say that now it is the lunchtime. You must be focusing on your on food. You must be hungry, but have some patience. Stay with us for another 15 minutes and then Yeah, you are okay. Okay, so coming to the point, I strongly agree that the fintech should be regulated because first of all, it is all about your finance, and finance cannot be kept loose. Secondly, we are in a developing country, and we are known for the so many regulations. And third one is because fintech is not cannot be controlled by a uniform policy. It means that one size fits to all don't apply to the fintech because we have the different authorities, primarily being the Federal Bank, the Reserve Bank of India, SEBI is there, IRDA is there, and so many authorities are there. So if we keep it loose, there is a big threat to losing the privacy, the confidential information, and as you know that data is the big power, it is the money now. And then biggest problem which might come will be the money laundering cases also. And there are the acts like PMLA, Prevention of Money Laundering Act, under which the regulations are very tight and requires the fintech players to keep the records of their KYC for their clients and maintain the records, etc. So this is I agree that it should be very tightly regulated, but not in the sense that all the business models has to be challenged. Business models should be seen from an open mindset by the regulators, and regulators sometimes needs to be the facilitators, not just the regulators. So this is all from my side.
Okay. If I understand your question, that first of all, you asked that whether we require regulation. Second question is that whether we require additional regulation. Additional regulation because there are existing regulations. So I agree to the point. Regulation. And do we require additional regulation? I try to recall my class, maybe 2007, 8. I was teaching something, and there's a student who was working at a telecom company and just came from Kenya and said, I just launched one product in person. What is that? For the first time I heard about that. Then the in-person became a global story. Right? And in Asia, Philippines is the first country which actually launched mobile money. So if you see, these two examples are not from the development, they're from the development. So the requirement for a digital-based payment system is the need of the developing country because there are a lot of gaps of information, and somebody can actually exploit, or somebody can actually take it as an advantage for the development. Now, why we require regulation? Require regulation that all developing countries. So even if you have the best technology there could be poor infrastructure, there could be an existing complex regulatory system, and also could be traditional data. I need to go to the bank, I need to sign up, check, then only actually I remember when I was working with the United Nations, there is one colleague who is from erstwhile USSR, member country. He said that in most of these countries the IT technology is quite good, but still the elderly people want to sign on the piece of paper. They are just not agreeing that there is a digital technology. So we have a different framework, and that framework refers to. Now coming to the regulation part, as I said in the technology is always one step ahead of it. So regulation doesn't mean that at the end of everything, regulation also needs to get involved. Now, what we see in the literature, there are two aspects of regulation in which the fintech regulation. Now, one is basically market conduct regulation, and another one is customer protection. Now, in the banking and insurance systems, you have customer protection, but just to be heard that cybersecurity is a digital aspects which was not there in the existing banking system. So it is actually also required. So every country requires a different framework. But what would be India's trademark is basically as part of our cultural systems, as part of our existing systems, and there are many aspects like it could be payments, it could be banking, it could be lending, it could be investment, it could be insurance. For everything, there are different authorities and different regulations. Of course, we cannot have one single regulation, there is an umbrella under which we can live, and it works really well.
Thank you. It was in the context, I remember when we had fierce growth of our IT sector. And lots of people were saying that the kind of growth IT sector is experiencing is because the government forgot to regulate it. So in that context, I said, is the fintech story that we have seen so far, the rapid growth, both in number of fintechs as well as in the kind of funding they have got, is it because there was some lax regulation on the part of the government? And a lot of people did feel, yes, regulations are different, and that is why people are also making use of some regulatory arbitrage. And the moment, let us say, even on BNPL, when all those regulations came, the first accusation against the regulator was, oh, why are you trying to stop, the growth of fintechs? So regulations to be seen as a hurdle to the growth of the sector, or is it a facilitator? And not just a facilitator, an accelerator. I've also heard a comment which says London is what it is today as a financial center because of the regulations. All right, so it is the regulations that have really put so much of growth in London as a financial center. So in that context, we had said that how do we see regulations? Of course, necessary, but in what context? Are they really very much something that is going to pull the growth of fintechs? And that's why we don't complain against the regulations rather than welcome them. I know you talked about certain regulations which are maybe not so clear, and clarity comes as we go along. So in that sense, or let's say the regulator just turning its position, maybe making a U-turn, and suddenly, like even in BNPL, so many entities got into it, and then one fine day you just have to stop operating. Certainly, it is not easy for the entity which has spent so much time and money on it. But from the regulator's angle, obviously, protection of the investors, the borrowers is important. So the question is, even in case of BNPL, we don't deny that the regulators had to take those steps because everybody has to be protected, including the small borrowers. But was this step a bit too late? I mean, this step could have been taken before the BNPL took off the way it did. What would you say?
The issue which generally RBI or any regulator face is that the technology that it is growing with such a pace that you cannot catch hold of everything. Like if the crime is happening in your city, police is also aware to catch those crimes. They can be proactive in catching them, or they can be reactive in catching them. Either they can catch after happening those crimes, or they can create such policies that they are proactive enough that the crime does not happen at all. So similarly, regulators are also facing the issue that the pace with which the fintech is growing is you cannot, like in 2020, you were seeing lending or you were seeing PPI. Now you are seeing 10 more departments into fintech. Now you are seeing wealth tech. Now you are seeing insure tech. So the kind of speed which it is growing is stopping, or it is unimaginable for the regulators also, that they should move with the pace of the fintech, or they should be reactive enough that once they see that this is happening bad or this could hamper the consumer, then they put restriction on that. If I talk about a new product, that is FLTG. first loss before guarantee. Now, what comes into this, government has also stopped this FLDG program, but it is moving into the society by different agreements. Now, there are top law firms who are creating the FLDG process into a different line of segment in which I would co-brand with a bank, and now I can give money to anyone I want. Like if there is a last mile person who thinks that he wants a 5,000 rupees as a credit, and I say you that take this 5,000 rupees, and at the end of the year you pay me 8,000 rupees back. As a customer, you are okay in paying that, but as a company, you are charging 100% interest on the same. But that cannot be allowed. As a traditional bank, they were not allowing it. But as a fintech company, now you can do it. But there should be some regulation which should come into the picture beforehand, and there should be some regulation when they are seeing that the consumer is being affected, they would come as a reaction also.
So anybody has a quick comment on that?
Yeah, I agree to what Harpreet has said. And to give you a like example is like this, that 25 days ago, 3 firms got caught in Bangalore. What they were doing is one company was holding a NBFC license. Okay, so NBFC license, with the NBFC license, you can lend the money, of course, legally. But what they were doing is another agency was giving the money to the NBFC in the form of security deposits. And in the balance sheet, it was showing as a security deposit, and then the NBFC was lending the money. So money was not belonging to the NBFC. So they got this, and this typically is termed as the the license lending. That people lend their NBFC license to someone else who is wealthy, who has the money. So this has to be stopped. But what ma'am has pointed out, like buy now, pay later, BNPL. So I tell you, in the last 2 years, the BNPL growth rate was 600%. So this is the evidence that authorities really cannot, anticipate what is going to happen, as Harpreet rightly said. So postmortems has to be done. Prevention is better than the cure does not apply anywhere, because technology is, like an explosion. When it increases, it increases. So regulators have their own limitations, unless they build their capacities, they join the hands with the founders of the fintech to get their minds aligned with the founders. I think it is very difficult to catch.
So actually, I talked about some early steps because BNPL is an experience not just that India has seen. The rest of the world has seen. We have seen explosive growth of BNPL in certain other countries also, including China. In fact, in China, P2P growth itself was so very high, and suddenly one day it is put. So India is seeing those experiences, and so we know that if these products go out of hand, there can be a problem. So in that sense, I say that when we have seen already problems with these products, maybe because of lax regulation, so when we introduce these products, then we should introduce them with the proper regulation rather than pulling back the industry once it has grown. Okay. The other thing that I have to talk about is even the account aggregator framework. So I know, sir, that you have said that it is an excellent one, and I have seen certain banks itself comment. I was reading about Axis Bank. It says that our loan book has grown 10 times, within a few months because of account aggregator. There's so much of data available, and therefore getting to know all information to make those decisions is so much easier. Yet a question I had in mind is, in the account aggregator framework, like we have financial information user, financial information provider, and the account aggregator. Now, I think we also see that there's some kind of overlap between, let us say, a financial information user and an account aggregator. The sister company is an account aggregator, and they are financial information user or provider. So in that sense, Is there a conflict of interest which can later on create a problem? Because I've seen several such instances where sister companies are either financial information users or providers. And that, in my opinion, could be a conflict of interest as we grow bigger in the account aggregator framework. So from the, I'm sure all of you are using account aggregator framework. So from your experience, would you like to say anything?
I would like to say that account aggregator is a good thing that has came up to the fintech firms and the banks, because now you don't want KYCs again and again from the customer, which was very irritated. Like if you need a loan and if you are giving KYCs to, let's say, HDFC Bank or ICICI Bank, and now after a year or so you are looking for another loan, then every time you have to give the KYC to a new lender. Now by that framework, the thing that can be solved is your KYC is not moving into the market now. You will give your number and the bank will automatically pull out your KYCs. So the KYCs would be kept in place now. Now, as ma'am said that there are sister companies which can misuse this information. Rightly said that it could be used, but before the government is giving them a license of account aggregator, then they can see that is there any sister company of that particular company into the same line of business, then they should not give the license at first place. And if it is not, then it is the best thing which we are seeing as of now, that AA is the best part, that is making sure that a customer is not taken for the toss by the banks or these traditional lenders. So by AA framework, the Customer Protection Act is strongly imposing the customer that your KYC is kept in place and it won't be used anywhere else.
Right. Yes, sir. We actually want a comment from you.
RBI has, RBI has guidelines on
How account the sister companies, they consider this conflict of interest and then, they impose that condition.
you have to be.
I know that for a reason. I know
But
that.
they are still sister companies.
I think that is not allowed to the best of my.
Then, at least to the best of my knowledge, that's not allowed. That's considered by the committee and it's flagged. There is a conflict of interest that is suddenly flagged, at sea level, and then, for sure I know this.
I was just seeing the list of account aggregators.
Should point out, please write to me, and I will also make it notice, but at least this conflict of interest is not allowed. The account aggregator has to be separate, at least that's my knowledge. The other thing, the account aggregator is not supposed to store any information. And there's all the encrypted information is the pass-through, So the strict guidelines of what it is done, and then, Revit takes care of, looking through that entire thing before even the grant is given. So the framework is very tight. And then it's, very nicely, done by, RBI FinTech department. And I think it's well regulated. So I don't think, the concerns are,
Surely. Sure, they are mere fights, but I just had a problem whether any of them should be allowed to be acting as an account aggregator.
Providers data, screen scraping for this purpose. But then there are arm's length relationships. I think RBI is very clear about this aspect when they've given license. So in which case,
So I would also like to contribute that actually account aggregator is a proper license entity which is for which the aggregator is licensed, and the data is actually transferred in a completely encrypted manner. So and you can't know it's like if I am a restaurant owner and I want to transfer that particular piece of
what exactly is the business. I would never know what exactly is being delivered to my end customer. So it is like it is as good as sending something in a complete level. Only FIU can do it. I have seen cases wherein we have TSP, which are technology service providers, which are also have a separate sister entity. For example, OPO is the biggest
Exactly,
example.
I was talking about that.
So OPO is not a FIU as such, but they are technically a TSP, which are helping banks and NBFCs to make some meaning out of this data. So once the data has been transferred, I need to make some sense out of it. Suppose I want to make a credit model out of it, like whether I should give a loan to this customer or not. So one part is that I've got the data analysis format, that is one. But then I need it for the nowadays biggest use of our calculator as of data is bank statement analysis. Now I want the bank statement data analysis. But I want to check what are the debit balances, credit balances, what is the total number of check deposits, and end of the day I want to make a decision that should I give money to this person or not. So that's the ultimate objective. So there the tech companies which are TSP and RBI actually defined TSP, technology service provider, you can actually make a meaning of the data with the concept of FIU. The FIU concept is important for the TSP actually.
Banks who are choosing to be participants or whatever, anybody is choosing. If you are becoming an FIU, you want to utilize the data, you have to necessarily open up your pipes for becoming an FIU. So you cannot do either or. So which means today, let's say a bank like Axis today, if they have benefited from this, there would be another entity who would have benefited out of having access to the entire list of liability customers, wealth customers, etc. So it's like a very democratic, which is perhaps the reason why you can say, well, it's seeing a lot of adoption, a lot of entities are just sitting on the thing. Bottom line, because they always feel that if we consume data, we will have to give data out.
That they need to maintain. There is an entity that is applying. I think that is carefully checked. In case you feel that something is being compromised, I think you should flag it.
Yes, I will write to you
think
because
the
I support
account
this company.
aggregator framework, in my opinion, is an excellent framework for allowing consent-based data to go. But what is really go a next step is basically it doesn't actually have a provision for mining, and it's difficult to add to this because a customer gets all his data, he can mine it, but then he's not the right person to be doing that. Somebody else should do it, again. Which the big tech is doing. That still is not part, in my opinion, of the account aggregator. Something that needs to be, if we have to take it further to a different level, we need to do that.
Actually, I'd like to add here that we are incubating in cybersecurity center of excellence. We incubate startups on security and privacy both. There are startups which are addressing this very problem. For example, we have one startup called Market Consent, in which different parties all saying information and stuff, and who should utilize or have access to information for what purpose, and when should they use it, what should they use it for, and all these things. Their platform takes care of all that. So in fact, that tech is coming up in a very strong way.
On cryptocurrencies, I know several pronouncements have been made. Often we wonder whether there is clarity on whether India wants cryptocurrency or doesn't want. But as far as G20 is concerned, at least there is that feeling on crypto, whatever regulations we have to come about, it will be after consultations with all the other regulators in G20 group at least. So my question was, why only for cryptos? I should be anyway talking to other regulators regarding other products also. Is it because we see maximum risk in cryptocurrency that we find the need to talk to other regulators? Because I feel even for other products, for example, counter terrorism measures, etc., or money laundering measures, the first thing that is required is sharing of information. The more you share information, each regulator shares information with the other, it is definitely going to curtail those practices or those events that we consider to be highly, highly harmful. So again, the cooperation with the regulators, should it be only on a limited number of products or on all products? This is not.
You have rightly mentioned, I have one data which is that, India's cross-border, talked about cross-border, is quite fragmented, and there are several collaborations. For example, UPI is having collaboration with the company, and there are other countries like Japan, China, Sudan, UAE, several countries. So there are bilateral level there discussions because it is the world of the international community. So these basically gives us an idea there to be little of other areas where actually there is a now the question is what will be the forum for that? Now, several trade agreements actually is considering financial cycles as an important area to discuss possible collaboration. So, trade ministries in different countries are quite proactive. In some countries, finance ministry backs up the trade ministry to move ahead in handling the financial. So it's not just in case of one aspect. Of course, terrorism is one of the issues why that discussion started, but now money laundering also is important area. But even for common people when they are transacting, for example, export, everybody interportability with a major issue. So for which actually we require collaboration. May not be all the time bilateral, it should be unilateral or multilateral. In that case, WTO should be more proactive in financial services. I mean, we are seeing in the last few years, especially during the COVID time, not as aggressive as it was of promoting this type in different countries. So, surely, and regarding your earlier point, the fundamental of regulation, when there are multiple regulations there, is basically one principle and secondary. Like, if it is a financial system, so what are the core regulatory systems, like in banking, like in insurance? So this will be fundamental. Any fintech who is coming to that field will be regulated automatically by that. And then we top up regulations because the nature of their business is different. So a lot of corporate regulations, for example, having sister companies and kind of treating shell companies and buying shares, those could be the possibilities, but actually the corporate ministry. So one side, of course, that is not the question of one size. Actually, it's a different people altogether. Actually, you have to buy things for different people. It's quite
Basically, fintech, like any other digital technology, we generally talk about, there are three aspects, three reasons or fundamentally why it's there. One is for the experience, that is, you get better experience, right, when you use digital technology. The second thing is for efficiency, you get better efficiency. The third reason is possibilities, which is innovation, right? So now in all these three areas, there can be innovations and there can be regulation. The regulation is there. Saying that this is the way it needs to be. Because in efficiency, if you don't have regulation, then it cannot scale up, it will create a lot of problems. So now, even possibilities, there would be kind of possibilities like, let's say, there's an Australian who wants to invest in an MSM or SME in India. Okay. Currently, if he wants to invest, he has to go to, so he wants to invest a small ticket amount, right? Let's say $2,000 he wants to invest. and he's diversifying his portfolio. So if that is the case, and we want to open up so that we attract investment outside, he can't do it so easily. He has to do currency conversion, or take over, probably all these things in the time, all the margins and all that. So one way out would be to looking for crypto, DeFi, lending and all that, decentralized financing. So even if that is not there, one of the persons who comes to you saying that since you cannot directly invest in the company, you can set up fintech company, invest in or they will invest return into the company. So these are the possibilities that are there. And we should not stop innovation. The only thing is we need to be very careful of, as you had mentioned, the bad apples and all the other things, negative use cases around dangers that can be there. People need to do more research on it and then come out with it, because even today we take it because of being cybersecurity. The cybercrime prevention rate is basically less than 1% of the history because of all the things that are happening now. Okay. So with this in mind and if we're racing ahead in digitalization, we would really like to have a vision for hand in hand with this closely for the day.
Thank you. So I have 2-3 other questions which I'll combine because of the paucity of time. So whoever wishes to answer those questions. So one is in trade finance. And in trade finance, people, bankers are also a bit hesitant. And the reason is, KYCC, if there is, my client does something, I am held responsible. So in that case, obviously, once again, the sharing of information becomes very, very important. Otherwise, the bankers will always be reluctant to enter trade finance. So my question was whether RBI has actually thought about, other than AML regulations and counter terrorism regulations, whether there is anything that is between the bankers, easy sharing of information so that at least trade finance can pick up. Otherwise, that remains unfinished job, according to me. My second question is on how easy it is to get a license. Right now, this fintech license. I'm not saying that there are any complaints from anybody. It seems like RBI is doing a good job, but the reason I'm saying is, let's say after Brexit, Lithuania in EU, for example, has become a center. All those firms that were in UK, they wanted to tap the EU market, so they have all taken license from Lithuania and then got the whole EU market. That's because Lithuania took very proactive steps. While they were discussing Brexit, Lithuania, tried to firm up all its procedures and is even giving online licenses to these firms. And firms that have bigger ambitions, they are getting the license in US. Because once you get a US license, the whole market is there for you to operate. So I was just wondering whether our regulators are also thinking of how our fintechs can go overseas, and similarly, whether overseas in fintechs, are we trying to attract them in some manner, even if it is simply by ease of licensing? So these two questions for the moment.
I think, we need to answer. So now the international market, there's like actually doing that. Huge move. Some consideration I'm expecting. This kind of many players going on and many layers of regulation. It's just a matter of time, because we have seen in the past in other sectors also, and there is a market.
So maybe we can have the regulators' viewpoints, sir. Would you like to comment on that? Okay. So I think since we have very limited time, we'll just keep it for the students. If you have any questions. Okay, so the fintechs, as we see, another thing that I might just add, more and more we see firms moving from B2C model, at least in other countries, and I suppose the same thing should happen in India, to B2B2C. Right, so even on digital lending, like I was reading that there are these fintechs that don't do lending, but all that they are doing is providing credit information to the financial institutions. Their strength is only that and technology. They will not do marketing, they will not do servicing, no collection, nothing. But that is there. So they give to the financial institutions, and then the financial institutions will take the loans which they are comfortable with. The ones that they're not comfortable with because of the high risk, some other institution, maybe private funds, they take over those. And so the banks give the loans, but the risk has gone to the other player. So again, my question was, do you see some such thing happening as a fintech player? Do you think this B2B2C model is under consideration?
Yeah, I think it should be into consideration, but as we will go ahead into this market, then only we'll see how it is performing, how it is going. But as we were talking about the FLTG product, that the NBFC is telling us that you can fund it to the customer, but the default guarantee is coming up to that fintech company. So they are doing the collection, they are doing the credit analysis, but the who is enjoying, the NBFC is enjoying, who is giving the money on the behalf of a fintech company. So what they are doing, they are asking for a let's say security deposit of 15%, and they are telling us that this is a businessman, you can give this customer at any rate you want. This is a minimum 15% which we will charge from you. Now, if you want to give at 30% also. So now, like banks and NBFCs are earning the interest income, now fintech companies can also earn that interest income by giving high rate of interest. But that again come up to the customer that why should they pay high rate of interest? We have opened fintech to solve the issues, not to bring more issues to the customer. So that funding going to the last mile of the customer should be low cost. It should not be at that cost that he's saying, yes, give me fund, but he comes into collection. He's unable to pay that fund. So as we move along with this industry, we'll see good players coming, bringing new things, new technologies, so that it can solve these things which are coming up to us currently.
So thank you. I think we have seen a huge growth of the fintech sector, but there's lots more to come because payments and lending alone cannot be the things that define fintech. So like the models that I was talking about is something that we shall be seeing, and more we are going to see specialization even in lending. Somebody doing only agri sector, somebody doing only maybe logistics sector, which is the fastest growing sector, which is receiving attention from the government. So the regulators are going to be with us, and we have to welcome the regulators, because even in BNPL time when this crisis arose, I still remember players saying, God, there are regulations, because now the ones that are not good will automatically close. So India will also see consolidation of certain fintechs, but regulations is something that is providing the guardrails, and therefore I think RBI Innovation Hub is doing a great job by actually inviting all of us to give views on any aspect of fintech. I really request the students to visit the RBI Innovation Hub and see how all of you can contribute towards the goals that the government has, all this financial inclusion, sustainability, etc. RBI Innovation Hub invites all of us to contribute in whatever way it is possible. So thank you all for being here. I thank all my panelists for giving their time to us, and the audience for very patient hearing and participation. Thank you. One second.
Closing remarks, I just want to add one more.
I think RBI also has this sandbox framework. See, one of the key things that's happening is regulator wants to catch up with the technology, but as you rightly pointed out, technology is fast moving. Now, I think the role of the regulator is taking a different level of actually, responsible innovation, because they have to be, some kind of responsible innovation as technology is going. To that extent, I think RBI has this excellent program on sandbox environment, and they keep announcing these sandboxes, where anybody who has a solution in that particular. In fact, the current one, as I understand, is an open team. It means anybody on any team can submit to them, and they will actually provide the regulatory sandbox under which they can test their product. I think this is an excellent idea. All over the world, people have started doing this because there should be responsible innovation in the financial sector, because the impact is huge. If any kind of effort there, has a huge impact. So I think the students should also look at that sandbox environment that are coming up. That's an excellent way of participating with the ideas into the fintech environment. It is done by the fintech department.
Yeah, I'd like to add one closing comment from my side, that technology is racing ahead at such a pace that these devices and the AI, especially, in fact, you can classify it into pre-chat GPT and post-chat GPT. Entire whatever papers you read, a lot of things are going to get relegated to AI, and all which are going to take decisions, and they're going to be sophisticated models and all that. So it is devices, the phenomenal rise of devices, right from IoT to many things. These are, in fact, overwhelming, and a lot of things will come around that, including device fingerprinting and all this. Let me just give an example. There's a fintech firm that I know of, with some people working. First, they're in US, I think piloted in Dubai or somewhere, and then come everywhere. That basically, when you go to the car, you pull out the credit card or something. Go to the petrol pump, you pull out the credit card and do it. Now, there's a question that with NFC, near field communication, why can't the car pay the bill? Okay, so this is itself, so they're already piloting it and say that's the space at which it is going. So what is going to happen is, so far we have been having KYCs and all those things. Next, you will need to have device identification, rogue devices, and all sorts of things. So to that end also, there is research going on. For example, you may feel that one device is equal to another device is equal to another device. But if you go down to the nano level and the clock cycle, the clock skew level, then nanosecond difference will be there. So this thing knows that, yes, what kind of a device it is, and it has some unique fingerprint. And also different devices. For example, you are watching on TV, probably coppers a lot. It is a light bulb, which is smart bulb, because practically everything is smart, all of that. Then thing will have flip bulb, then it's send a system.
You're right, KYC to know your device.
Devices also, everything has to be identified, because they are playing a very big role. They take towards with intelligence, AI, and everything. So
Right.
with that, I think.
Right. Thank you.
Thank you so much. Thank you so much, Subhadya and the panelists for such an enlightening discussion. I would like to request Professor Ojha to please come on stage and felicitate our panelists here.
And yeah, in terms
सर ग्रुप फोटो है
Thank you.
Now is the time when I will give the word thanks, then we proceed for lunch. Also. So I would like to thank RIS, Ministry of External Affairs, for giving IFT the opportunity to speak with Connect. I would like to thank EDDC, that is European Business Technology Center. I would also like to thank keynote speakers and participants for their valuable time and coming over making an effort to coming to IFT to make this program a success. I would like to thank different institutions and their nominations. Last but not the least, Mr. Bhatia, the Vice Chancellor of IFT, and Dr. D.K. Gupta, the Registrar of IFT, to provide support. And in the end, would like to thank faculty, staff, and students of IFT for making their contributions and success for the program. Thank you. Now I'm waiting for lunch.